time last year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
We've got a bounce back from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Up 24 on the S&P 500. We advanced 0.6%, and the President of the United States advances the vaccination timeline, Tom.
Yeah, I'm glad you bring that up, John, because I really do think it folds into what Texas has done with a full reopening by, I believe it's March 10th. But also to get out to that 300 million number the president is suggesting is really important. And that is the backdrop for what's become, John, a trading range. I go back to February 8th-ish. I mean, we're getting back now a good 3, even 4 weeks of moving nowhere within the bid that we see this morning.
At the headline level, struggling at 3,900. Yeah. But, Tom, the churn beneath is absolutely massive still. The gains we've seen in financials, in energy, that's been a story of the last month. Yeah,
there's no question about it, and that's the active-passive debate that so many of our viewers and listeners are talking about. The other thing, John, I'd point out today is we're getting used to 1.44%. You know we had a seismic change here. The real yield on Friday will be different than the real yield of 3 weeks ago or so, because we're getting used to where that 10-year yield is. We're getting a little bit of comfort with it.
Desensitized maybe by some massive moves in the Treasury market after seeing 161 in Thursday's session. Lisa, you put together the fact that we're advancing this vaccine timeline. You throw in Governor Abbott reopening things in Texas. We can talk about that a little bit more later. And you add in a $1.9 trillion fiscal plan. Just enough reason, many reasons altogether to really lift your GDP forecast. And we've seen that again and again and again over the last couple of weeks.
Yeah, that optimism very much in front and center and just building as we get new news. I do want to add this idea of the Treasury yield, the 1.44% yield, and the idea that we're getting used to it. I think that there also is somewhat of a cap to the volatility that we saw when Lael Brainerd of the Fed repeated 2 consecutive days that she was concerned about the volatility we saw last week and will carefully monitor it. So there is this sense, she's the first of the Fed to come out and say they are watching this, a sense that they are the ultimate put and they will remain so, as they do not see necessarily their goals being met quite yet.
Ahead of Chairman Powell coming up on Thursday and just before payrolls Friday, just around the corner from New York City this Wednesday morning. Good morning. Let's get you some price action this morning. We look like this on the S&P 500. Equity futures up 21. We advanced by around about 0.5%. In the FX market, euro dollar 120.79. Your euro just a little bit softer, weaker, lower, down by 0.1%. And in the bond market, there's the lift again, Lisa. Yields up 5 basis points on 10s to 144.
Yeah, but really the key here is that it is controlled, right? It isn't the same kind of rapid move that people don't quite understand with air pockets of liquidity, which is what people are talking about now, which definitely has calmed people down. In the meantime, John, you were talking about the jobs report that we're going to be getting on Friday. The drum roll is getting louder. 8:15 a.m. We're going to be getting that ADP employment figure for February. We are expecting about 165,000 new jobs to be added. That is the consensus. Bloomberg Economics has it up higher at about 250. Unclear what this means, but we are expecting to see progress as we do see a reopening in economies, Texas, Tom, among them. Also today, that drum roll to Fed Chair Powell tomorrow continues to get louder with more Fed speak and more Fed speak. And more Fed speak. The Fed's Patrick Harker, Raphael Bostic, and Charlie Evans all coming out. Interesting to see again how concerned they are, to reiterate what Lael Brainerd was talking about the bond market volatility. Also, what their key metrics will be to determine whether they're getting closer to their goals. John, you were talking yesterday. Is it an evening out in the employment figure? Is it an evening out of the wealth gap? What are their metrics? And then 2 p.m., I can't wait for this. I know you guys are so excited for the Beige Book. I wait for it every month. This month, it actually will be really interesting to see on-the-ground data showing how much the economy is recovering, whether we do have data behind this optimism that we're seeing in markets, John.
You do actually wait for it every month, and Tom and I really aren't excited about it.
I've never looked at the Beige Book.
That doesn't surprise me, Tom.
I never have. I mean, in honor of the great Richard Yamarone, who left us way too early. John, he was an expert at this with this acclaimed Orange Book. I've never looked at the Beige Book. John, on payrolls quickly here, you and I are watching this. We migrate from 188,000 on survey to a new statistic this morning of 195,000.
Creeping just a little bit higher. We saw that last time around, didn't we? I'll be looking at ISM services, Tom, add a little bit later today. Looking at that right now,
You'll
high
do that
50s,
on one of your other
58.7. In fact, I think Guy Johnson and Alex Steele will break down that number at 10 a.m. Eastern time. But the numbers have been really quite terrific, and the outlook is getting better and better. Here's a line for you. Certainty isn't the tailwind for performance. Uncertainty is. A line from a wise man, that wise man, Chris Ferrone, strategist partner and head of technical and macro strategy. Chris, just run me through that. Certainty isn't the tailwind for performance, uncertainty is.
And I know how counterintuitive that sounds relative to everything we've heard in our careers, but when you look at forward performance, forward market performance is always best from the most uncertain of moments. It's actually quite average from the most certain of moments. And that's why I think this is an interesting moment. We look at an index called the Policy Uncertainty Index. It tries to measure how much uncertainty is actually out there. It has spent the last 11 months in this extreme territory. Over the last week or two, it has started to recede back to more normal zones. The returns from there are more average or more normal going forward, not exceptional. And I want you to think about this in context of year one of a new bull market versus year two of a new bull market. In year one of a new bull market, the returns are exceptional, but it's intellectually mystifying, right? How can the market be up so much when the economy is so bad? Year two is the exact opposite. The story and the narrative becomes clearer and more certain, but the forward returns are actually typically harder to find. That's where I kind of think we are. We're making this transition from year one of a new bull to year two.
Chris, in your wonderful research note, and folks, Chris Ferrone, just really great leadership on trend-based technical analysis. The trend that you see is always broken up into a wonderful sector analysis. You talk about the sector matrix. Help us here. He's as good looking as Mr. Reeves now that I think about it. But Chris Ferrone, help us here with the sector matrix that tells you it's not March of 2000.
Yeah, you know what's been so interesting about this move, particularly over the last several weeks as the market has paused here, is that the declines, the down days, have actually been very, very narrow. There has not been broad selling pressure on any of the weekdays. And I think about that, if you look at 2016, 2017, 2018, 2019, those were broad advances. So we've kind of transitioned into this period where the declines now don't look like what you've typically seen, those broad-based declines. They're narrow declines. When I go back to 99 was so narrow. By the time you got to the March 2000 market top, only 35% of stocks were above their 200-day moving average. That is when accidents happen. We've spent the last 6 months with something like 85 or 90% of the S&P above the 200. That is not where the big accidents tend to happen. So we look at that on a sector basis, and I'd say most of the market cap of the S&P is still pretty broad here. When that starts to narrow is when you've got to start thinking about problems. I just don't think we're quite there yet.
Okay, so we might not be seeing problems, but am I hearing you right to say that you're seeing lower returns going forward? And if so, how much lower?
Yeah, I think just thinking about this in historical terms, year two of a bull market tends to be decent, but not a straight line. Think about 2010, right? 2010, we're a year off the low. S&P finishes up the year, I think 13% in 2010, but you had a 17% drawdown along the way. Or mid-84 through, let's call it mid-85, right? Year one and a half of a new bull market. It's not a straight line higher. The year finishes pretty good, but there's a good correction along the way. Yeah. That is what I think 2021 is going to look like. I think the full year returns are going to be fine. What I'm a little less convinced about is how we get there.
Chris, one of the great things about trend-based analysis is the quiet times. John Farrow was talking before we went on air about the range bound back to February 8th. Maybe you've got a different date than I do. I go back to the wonderful Louise Yamada on point and figure charting, where she talked about distribution of the back and forth of a quiet time. What do you do in a quiet time to position yourself for your belief?
Yeah, you don't short dull markets. That's kind of rule number one. But listen, if you think about these last 4 or 5 weeks since early February, I think you're absolutely right when you talk about February 8th as kind of being maybe an intermediate term high on this market. But if you look at the last month, leadership has still been very, very pro-risk. This is not a rotation into defensive groups or risk-off groups. The breadth has still been pretty broad. The down days have not seen the big selling pressure. So this looks more like a pause here than it does the start of some big distribution phase. My gut says if we're going to get a good correction this year, and we will at some point, my gut says that's more of a summer story, not a spring story. And I think importantly, as we look at rates kind of settle here in this 145, 150 zone, I'll get more uncomfortable when bond yields are going up and utilities are going up, right? That's the market discounting trouble down the road or trouble in the future with the shift to more defensive leadership. That has not been the case yet. I mean, the last 2 or 3 weeks, as we've seen this 40, 50 basis point move in yields, utilities are still among the worst performing group. So I think you'd see more defensive leadership before big problems start to emerge.
Really good final point there. Chris, we've got to let you go. And you get away without talking about Japanese banks as well. We'll do that next time. Chris Verone there, Strategas. Thank you, sir. Look, Chris brings up a really important point about what's happening beneath the surface, and let's talk about the why. Two of the biggest weightings on the S&P 500. Let's take your pick. Apple, Amazon right now. In the last month, Apple's down 6.7%. In the last month, Amazon is down 7.4%. And this just walks you through, Tom, how technically challenged that benchmark actually is right now because of the weightings of some of the big tech players. That you can have this huge run-up elsewhere, but you can have this range-bound headline benchmark of in and around 3,900.
I thought John Golub, John Farrow, was just heated. Is everybody on the show named John? I thought John Golub was just heated the other day with Credit Suisse about how you look at those big techs, not within the short-term back and forth, but more of a long-term play. I mean, everybody's got to think here about what their timeline is as they play in the market.
Short-term, the challenge, though, Lisa, it comes from one place. It comes from the bond market.
Yeah, and the idea of how quickly yields are going to go up and what that means in terms of whether it's a bad rise or a good rise. I will just point out, when you're talking about divergences, the Russell 2000, just amazing. It's up 13% year to date. Compared to, I guess, 3% for the S&P. I mean, just talking about this divergence, exactly to your point, John.
Not bad, not bad. Coming up on the program, big commodity run-up too. Francisco Blanche, Bank of America Securities Head of Global Commodities and Derivatives Research. Looking forward to that conversation. Your equity market this morning shaping up as follows. Up 0.5% on the S&P, just south of 3,900 on the S&P 500. We're up 20 points. From New York City this morning, good morning. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. President Biden says that by the end of May, there will be enough vaccine doses for every American adult. And he wants teachers and childcare workers to have priority. The president called for states to give all of them at least one dose of the vaccine by the end of this month. It's part of a new drive to reopen schools. And it's President Biden's first major setback in filling his cabinet. Neera Tanden asked to withdraw from consideration to lead the Office of Management and Budget. Senators had objected to her partisanship. Tanden led the Liberal Centre for American Progress for almost a decade. In the UK, Chancellor of the Exchequer Rishi Sunak will extend furlough payments to workers through September. That will protect millions of people whose jobs have been suspended during the coronavirus pandemic. The British government will keep paying 80% of wages for those in the programme through June. That allowance will decline over the following 3 months. And the upcoming Tokyo Summer Olympics reportedly will bar overseas spectators. According to the Mainichi newspaper, the decision takes into account public concern about the spread of the coronavirus. Organizers are still said to be considering how many Japanese spectators will be allowed. And Samsung has outlined plans for a $17 billion semiconductor factory in the U.S. The plans were filed with the Texas government, although Samsung also is considering sites in Arizona and New York. The South Korean company is trying to win more American clients and narrow the gap with industry leader Taiwan Semiconductor. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Friday is Jobs Day on Bloomberg Television, the first full jobs report under the Biden administration. What will it mean for the new stimulus package? The February Jobs Report, Friday morning at 8:30 on Bloomberg Surveillance.
A lot of what we've got to do is dealing with a maintenance backlog. Fix it first, I think, is going to be a very important mantra for us. It doesn't always have the same sizzle as adding something new, but the truth is we've got to be doing both, because you look at the conditions of so many of our roads and bridges as a country, and it's just clear that we can't allow that backlog to continue.
Pete Buttigieg there, the Secretary of Transportation, on the need for infrastructure investment and for fixing bridges and roads too. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. We are counting it down to payrolls Friday. Chairman Powell tomorrow, an ADP report this morning, and then after that, the ISM services read for the United States of America. A better America, and that's the outlook anyway. Futures up 20, we advance 0.5%. In the FX market, the euro just a little weaker, a break of 120 in yesterday's session. It was a brief break, Tom.
Talk about the euro, John.
120.83. I'll talk about the euro. I'm talking about the euro. I'll talk about the bond market in Europe as well if you want, Tom. It's hard to reconcile some of the speeches that we've seen publicly, the comments publicly from ECB officials, and what seems to be happening behind the scenes.
Exactly.
The team over in Frankfurt reporting this morning that maybe the ECB does not see the urgency to step right in. And looking at the data that we've seen last week, it didn't look like they lift their bond purchases either when things were really starting to roll over, Tom. So it's hard to reconcile the speeches and the public comments with what is actually happening at the European Central Bank.
I'm looking at the Swiss 20-year piece, and it just won't go up in yield. I mean, I think the market's sort of helping the ECB get beyond this. Don't you see almost a yield stasis
since Thursday, Tom, things have really settled down.
Yeah.
Really settled down. I imagine that Chairman Powell is quite relieved about that. I just wonder what that speech looks like this coming Thursday.
Well, we will see the different Fed speeches and ECB discussions coming up through the week. Right now, the discussion in Washington, Emily Wilkins joins us, our Bloomberg government reporter. Emily, I want to go to the coronavirus relief bill, or whatever the bill's going to be called, $1.x trillion, and juxtapose that against President Biden's new statistic, which is 300 million vaccines. How linked together is the stimulus discussion you're witnessing personally with the good vaccine news that we see?
That's a really great question, Tom, because that $1.9 trillion stimulus bill, it definitely has funding in there for vaccines and for vaccine distribution. But the dialogue on Capitol Hill right now, a lot of it's focused about other things in the bill. The vaccine's probably the most bipartisan part. Instead, we're seeing a lot of debate from lawmakers about other things, how big unemployment insurance stimulus should be, who those $1,400 checks should go to. So those are more what's happening in regards to debate.
John and Lisa have a drinking game for whenever I ask about the middle, so get out the shot glasses. Emily, real simple. Give us an update on the middle right now. What's the power of the middle in your Washington?
Incredibly strong. I mean, a lot of people are just looking to Joe Manchin right now as far as what he wants, what he doesn't want. You've seen him say that he didn't approve that $15 minimum wage. And when the Senate parliamentarian overturned it, you haven't seen the White House go ahead and try and challenge that. So I think at this point, you're still seeing a lot of strength right there.
I will say, Tom, if we are playing a drinking game and that is the parameter, then you are buying. Emily, I am curious about some of the details in this bill, the $200 billion going to state governments. And there's a story today on the Bloomberg highlighting which states are actually going to see revenues this year with that stimulus that exceed their previous projections pre-COVID. And those are all the states in the middle. And actually, some of the reddest states are included in that, whereas the blue states are not. They're actually still seeing the declines. How much is this type of allocation crucial to get this bill across?
I mean, Lisa, it's been very interesting to sort of see the debate around state and local funding, right? I mean, all of these lawmakers are representing states and localities, and yet there has been a lot of resistance to getting this additional funding for states and localities in there. I think part of it can be traced back to the fact that Republicans say that they are very concerned about passing a particularly large spending bill. They're worried about inflation. They're worried about raising the national debt and the national deficit. And so I think these are all sort of a larger discussion that's happening about the portion of funding in the stimulus bill that's going to go directly to states and localities.
So everyone's been basically trading and operating on the assumption that this is basically a done deal. Chuck Schumer of the Senate saying he has the votes necessary. Are there any potential roadblocks, or is this basically a formality at this point? The $1.9 trillion bill is all but passed at this point.
There are definitely still negotiations going on about supplemental unemployment insurance. We're going to see another vote-a-rama in the Senate where we're going to see more amendments being offered up. You're still seeing progressives try and push to raise the minimum wage. But honestly, at this point, as leaders pointed out yesterday, a lot of individuals within the Democratic caucus, it was going to be very, very difficult for them to vote against this bill, against voting, getting more aid out to the American people. And so you are seeing that confidence from Majority Leader Schumer, from the House Majority Leader Steny Hoyer, that they are going to be able to get this bill passed and get it passed by that March 14th deadline.
Just give me a minute to be really naive and ask a question. Emily, why can't they just negotiate properly? We want to hike minimum wages. What would you like to see? A tax cut for small businesses that might have to pass on that minimum wage hike. Why aren't we having that conversation?
I think that ties back to that March 14th deadline. Lawmakers really want to make sure that those supplemental unemployment insurance benefits are not running out. This is a deadline that they set for themselves months and months and months ago as the target here. And so I think it became a balance between what do we have time to do and what will we be able to do. Also remember, there is that other infrastructure bill that's coming down the pipeline that Democrats are expecting. And that also is another opportunity to add things like a tax related to the minimum wage.
Final question from me, Emily, and it's about the vaccine rollout and something this administration has done, and it's been welcomed, has put this country on a military footing. How on earth did the president, and this was Tom's question yesterday, get Merck and J&J to work together in the way that they will work together in a foreseeable future?
Well, I think the pressure right now is on just companies to get these vaccines out, to get the economy restarted. I mean, you're seeing a huge amount of pressure right now among this particular issue. You're seeing states like Texas that are clearly ready for things to get back to normal at this point. And so I think there's just a wider pressure out there on companies to work together and to get this vaccine done.
Emily, good to catch up. Emily Wilkins there of Bloomberg Government. We'll catch up with the medical community, the healthcare community a little bit later this morning and get their thoughts on Governor Abbott reopening Texas. Tom, controversial, I think, at this stage of the year.
Yeah, the Post even with an editorial, the Washington Post with an editorial immediately on it yesterday. John, my only question is, when's the next Texas?
When's the next Texas? Yeah, it's a good question.
Huge pressure out there. And you look at the statistics coming in and, you know, everybody's got their own statistics. But, John, I would constructively say Saturday, Sunday, Monday, Tuesday, those vectors are in a constructive direction to support Governor Abbott.
I'll let the scientists have their view on this, Tom, but the politicians have to weigh a whole host of pressures right now, and it's not just what's happening with the pandemic. On the economy, well, let's talk about the path forward. The president has now come out and said a vaccine will be available for every adult in America by May. That's accelerating the timeline. And, Tom, that is really good news for this country.
Well, it's the depth of it. It's 300 million. So, you know, if you screw up 50 million, John, that still leaves a lot of vaccines. And you wonder when we're going to see, you know, May, June, July, I don't know, where the United States says, okay, we've succeeded. Let's help other nations. And that's where dovetails in to an impoverished world or, frankly, a developed world that can't get their act together.
It's a global issue, and the global community needs some help. Much more on that through the program. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Coming up on the program, a conversation you do not want to miss on the commodity market with Francisco Blanch of Bank of America. In a commodity market right now, crude 60.89, up by 1.9%. From New York City, this is Bloomberg Surveillance.
leader are you?
I'm a leader that works on figuring out destinations that we should aim for and then chooses the direction.
Valuations, particularly sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York City, this is Bloomberg Surveillance for our audience worldwide, live on Bloomberg Television. Here's the price action this morning. Bit of a bounce back after another ugly day yesterday for big tech. The Nasdaq, positive 0.7%. The Russell is where your outperformance is. On the small caps, up by about 1.15. On the S&P, we advance about 0.6%. This is what I want to discuss. the relationship between what's happening in the bond market and what's happening in stocks in the commodity market, and the difference between an inflation shock and a positive growth shock. So let's start with the bond market. Yields unchanged on a 2-year at 12 basis points, on a 10-year up 5 basis points, on a 30-year up 4. So a slightly steeper curve here. Again, 2s out to 10s, 144.12 on a US 10-year. What's been the move, the driver behind this at the nominal level? It's been real yields. Real yields really picking up aggressively in the last couple of weeks. And let's just repeat what I said earlier, the difference between a positive growth shock and an inflation shock. What's the bond market reacting to in the last couple of weeks? Not the latter, the former. So switch up the board. How does this play out in the commodity market? This is what it looks like. When crude drifts higher, people always talk about inflation. But this is a growth story too. So this is crude on the year to date, up 25%. And look at gold. There's the towel. This is about real rates, a growth shock, and the changing opportunity cost of sitting in gold. Gold right now down 9%. Now, Tom, if this was just about inflation and not a positive growth shock, we would not be seeing gold where it's trading at the moment.
And almost going to a 1600 handle a few days ago. That is of note as well. John, what I would do is walk through the calculus of the real yield, and I don't mean the massive ratings for the real yield. You see it 1 p.m. Friday afternoon as John sets up for the weekend. But John, what I would look at is that nominal yield less the inflation expectation, and that equals the real yield. It's pretty much stasis now. But what's really interesting is across countries, the different inflationary pictures, and there's been some disinflation and deflation out there. This is a topic we're going to really drive forward to dovetail it with the jobs report on Friday as well. Right now in commodities, and of course every major house is really looking at the idea of a super cycle, the nuances of commodities, the metals, the softs, and of course oil lifting. Francisco Blanch rides the herd at Bank of America Securities, head of global commodities and derivatives research. Francisco, to cut to the chase and to paragraph 1, are we re-seeing now a new commodity super cycle?
Hey, Tom, thank you for having me. I do think we are seeing definitely upside pressures, and in some cases across the commodity complex, we could see super cycle-like behavior. But I do think it's going to be more concentrated on the metals. Unfortunately, I don't see that cycle happening in oil. I do see upside pressure on oil prices, but as you know, oil is the main commodity. Is the largest portion of the commodity market value. So, and it's going to be hard for oil to see the kind of super cycle we witnessed in the 2000s.
Off the metals, then, how do you apply capital on a bet of the Pacific Rim? Is it as simple as buying renminbi? Is there something more nuanced if you believe in a metals play?
No, I mean, I think you can buy industrial metals for sure. You know, we do like copper a lot. We also like nickel, although we think it's a little stretched right now. We think aluminum will perform well. And then, of course, there is also some of the precious metals that are used in new technologies like silver or platinum, palladium. So we like those metals. And think those have still significant upside over the course of the next few years. But you know, that's kind of the most direct way to do it. And then of course there is also the equities in that space, which I think are also interesting ways to lever into the metal story.
Allow me to jump in,
really
Francisco.
About energy,
yeah. I need to bring in the China conversation as well. What's your read on what's happening with China right now? And can you be this constructive on metals, on the miners, when the recovery in China is really maturing at this stage and not accelerating?
I think you can, because remember, the metals are not just about China. It is true that half of the world's metals demand comes from China. But what we're going to see in the next few years is a huge transformation towards the electrification of transportation, the electrification of industry, and also the decarbonization of electricity networks. And those three elements are very, very metals intensive. So in my mind, metals still have, I think, quite a run ahead. Energy is probably going to run too. And remember, as those vaccines get more and more distributed, and we heard from President Biden yesterday that we may have vaccines for the entire population by May in the U.S. Johnson & Johnson is going to really accelerate the vaccination process with their vaccine. That could also lead to a pickup in mobility around the world. But the thing is, we have 10 million barrels a day of spare capacity, 10% of supply still spare in the case of transportation fuels. So that's going to, I think, lead to OPEC tomorrow opening up the taps and tempering the price appreciation. But you'll still see, I think, the commodity cycle moving higher, with particularly with all the monetary and fiscal stimulus that we've seen so far.
Well, let's get to some numbers this morning. Brent 63.93, WTI 60.88. Francisco, where do you see this topping out? What are the limits of this rally?
So we think for this year, the limit's about $70 a barrel. So we don't see a lot of upside, and we think that OPEC is going to be quite careful, trying not to breach that $70 level on Brent, because obviously that could trigger a fair amount of response in the U.S. shale patch if they did. So I do realize producers are trying to be disciplined, but obviously there's something called price that can change the
Francisco, actually, can you elaborate on that, this idea of the price point at which shale comes back into the picture?
Right. Well, so remember, the curve is in very steep backwardation. So the spot price is very high relative to a forward. If you look at prices for oil 5 years out on WTI, they're actually under $50 a barrel. So what we think is OPEC wants to keep the curve in backwardation. That's definitely a key objective of the group. They want to collect a high price on a spot basis and give shale players the lowest possible price on a forward basis. And again, this means that they'll try to keep things relatively tight. But I do see eventually over the next 3 years, there's a risk, as I mentioned earlier, if demand accelerates beyond our expectations. And remember, the next 3 years are going to be the fastest 3 years of oil demand growth since the 70s, simply because we're coming from a very low base. But if we overshoot, that's where I think the upside risk over the next 3 years could be up to $100 per barrel. So that's our view, that we could see up to 100 if demand conditions really stand up to this level, so of 9+ million barrels a day.
Francisco, can you talk a little bit about the dynamics of what that would look like, that upside surprise, in terms of both GDP growth, in terms of the recovery in international travel? What would we have to see to get to that $100 a barrel?
So I think, as I said, from an oil demand standpoint, we will have to see over 9 million barrels a day of growth. We will have to be above 2019 levels from a demand standpoint by the second half of next year. So again, relatively quick acceleration. And we will also, that's from a oil consumption standpoint. From a GDP standpoint, again, our U.S. economics team is calling for U.S. GDP of 6.5% this year. Some of this spills into next year with growth potentially in the 3 to 4% range. So if that's the case for the U.S., the world follows along. We see a relatively weak dollar on the back of that, because some of this U.S. growth feeds into international demand for goods, as we've seen so far, and that feeds into a stronger Chinese balance payments. Together with EC monetary policy, all of that can actually trigger us to that higher level from a macro standpoint. So it's those three things, really. It's improving micro fundamentals, it's continued EC fiscal and monetary, and it's, of course, continued improvements in China's balance of payments. Those are the three key elements for a continued commodity rally.
Francisco, just a final question from me, just to wrap things up on the metals market. How supply responds there? Because they've been disciplined over the last few years because they got burned coming out of 2011, 2012. Do they maintain that discipline? Do you see them doing that, this story of value over volume that really started with Rio and BHP several years back?
I think they do. I think they do. And in fact, I think what the metals, I mean, ultimately, remember, one thing is very different in the metals versus energy is metals don't have something like U.S. shale. U.S. shale is short cycle. It can respond within 6 to 12 months. Nothing in the metals world responds in 6 to 12 months. These are very, very long investment cycles. We're looking at 7, 10 years. So even if they responded, they'll still probably respond by the end of the decade. And by then, we will have maybe 20, 30% of vehicles being sold into the market will be electric. And that's going to create some serious bottlenecks in the metal space, in our view.
I think we saw that from Volvo yesterday, looking for an all-electric fleet by 2030. Francisco, great to catch up with you, sir. Francisco Blanch there, Bank of America Securities Head of Global Commodities and Derivatives Research. Just the difference between the potential supply response on the energy side of things within commodities, Tom, and on the metals side of things too.
We talked to Jeff Curry about that, the microeconomist over at Goldman Sachs, with his call maybe more bullish completely than what we're hearing from Francisco Blanch. John, I would do what we do, and you and I do this every day where we dovetail two series. I would look at Australia renminbi, the Aussie dollar renminbi, with an enthusiasm for Australia. It gives it back to the trend, and I blend that in with the index, the ADXY, which really shows a Pacific Rim in stasis through all of 2021 so far. There's just a leveling there, John, waiting for which way to cut it.
The bulk of the Aussie move as well, Tom, was the back end of last year too. That reopening trade, really the story. And I think people are starting to focus on the dollar side a little bit more on that short position that we built up. And that's really the story now, Tom. The conviction around the US dollar. And we've just chipped away at that consensus view just a little bit over the last month or so.
And the relative GDP, Lisa, what's so important here is Francisco Blanch mentioned 6.5 GDP out of Michelle Meyer in that. This huge GDP in America on a relative basis to China seems to be, narrowed.
Yeah, well, and the idea here that now the U.S. is driving a lot of growth in China. If you look at the supply-demand dynamic, the U.S. is importing a tremendous amount from China. I do wonder how this $100 a barrel for oil really affects the short-term inflation play. And I do think we've got to keep that in mind as we talk about the near-term inflation spike that people are expecting for the longer term.
We're looking for $100 barrel oil, John, around the corner.
Here's one for you, Tom. Dollar yen just through 107. Just in the last couple of minutes.
Yes, that's important.
Handle.
That's important. Strong dollar, weaker yen.
Weaker yen on the screen this morning. Coming up on the program, Lawrence Sauer, Johns Hopkins Associate Professor of Emergency Medicine. From New York City, futures up 21. We advance 0.5%. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. President Biden wants to speed up the timetable for most Americans to be vaccinated for the coronavirus. He says there will be enough doses for all American adults by the end of May, and he wants states to give teachers and childcare workers priority. The president wants them to get at least one dose of the vaccine by the end of the month. U.S. infrastructure has received a mediocre grade from the American Society of Civil Engineers. That should help President Biden when he asks Congress for a major infrastructure spending package. The engineers group says roads, bridges, sewers, and the energy grid remain underfunded. And more problems for New York Governor Andrew Cuomo. Legislative leaders have agreed to curb Cuomo's pandemic-related emergency powers. That comes on top of calls for Cuomo to resign. He's facing an investigation into claims that he acted inappropriately towards 3 women. Plus, there are questions whether his administration covered up data on coronavirus deaths in nursing homes. And OPEC and its allies are set to cool off that rapid rally in crude oil prices. The OPEC Plus coalition is poised to agree on a production increase at Thursday's meeting. The usual differences are present. Saudi Arabia is cautious while Russia wants to open the tap. Still, all sides are ready to pump more oil. And shares of Lyft are higher pre-market. The ride-hailing company forecasts a loss for the first quarter that isn't as bad as expected. Lyft also said that the week of February the 28th was its best in terms of the number of rides since the start of the pandemic. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
80% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
When we came into office, the prior administration had contracted for not nearly enough vaccine to cover adults in America. We rectified that. And I'm pleased to announce today, as a consequence of the stepped-up process that I've ordered and just outlined, this country will have enough vaccine supply, I'll say it again, for every adult in America by the end of May.
President Biden there, the news there just at the end, that we get this just a little bit quicker, and the change of administration has put this country on more of a military footing to get the likes of J&J and Merck to work together. That's been a big change in the last month. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Your price action looks like this Wednesday morning. Up 24 on the S&P. We advanced 0.6% and take out the losses of yesterday's session. Those losses concentrated in big tech. Big tech getting smacked around by a bond market with yields higher this morning again, up by 5 basis points to about 144, Tom. And euro dollar, just briefly, quickly, 120.65. But the move in G10 right now is dollar yen with a 107 handle. You've got to go back to summer of last year, Tom, to get back to these levels.
Yeah, I looked at that. I have been waiting for a weaker yen at 107 to be important. 108, frankly, folks, is unimaginable, but that's something worth watching. I would note equity futures lift here in the last number of minutes. Lauren Sauer joins now, an update from Johns Hopkins University. She is adept at emergency medicine. I know John and Lisa want to talk about Texas. Lauren, I want to talk about the math of hotspots. In the blended statistics, you don't see the hotspots. It can be this story, that story, another story. Are we homogeneously getting better, or are we getting way, way better except for grim hotspots? Which is it?
I think it's probably somewhere in between, and it can fluctuate depending on the sort of timeline that you're looking on the data, right? So I would say we are a nation of hotspots in general during this pandemic. The outbreaks are moving based on where public health measures are implemented, based on where new infections are spreading, where rules are changing. And that is at least partially due to our disparate medical system and healthcare access, right? So in general, yes, things are looking better in the United States, but we do still have some concerning hotspots.
Vaccine supply looks secured. Maintain vigilance is the message, though. I hear that in the UK, hear it in the United States repeatedly from the administration, and Governor Abbott reopening things in Texas. What was your reaction to that, Professor, in the last 24 hours?
It was really hard to see. You know, Texas is a place where we have had these hotspots where the numbers are dropping, but they're dropping from an exceptionally high space. And we want people to maintain that vigilance. And I would imagine that after seeing that from Texas, that other states will do the same. And in fact, Mississippi wasn't far behind. I mean, just last week, just a little over a week, Texas had this massive natural disaster from the ice storms and the power outages. And so vaccines in many cases are delayed into arms, and some had to be wasted because of that. So there is a delay in public health activity there. So turning off all of the things that we know work right now is really unfortunate.
Looking at the numbers coming out of Texas, the vaccination, 7.1% fully vaccinated, 13.4% have had at least one shot. We know that that's been targeted towards the most at risk in society. Professor, I'm wondering, do you think that is enough to prevent severe cases from really starting to build again in the coming weeks and months in Texas?
I mean, I think it's going to be a wait and see. Personally, I don't think it's enough. I think we have to, I agree with the president, we have to maintain our vigilance. We have to maintain these activities that we know work. I believe the governor mentioned that we had all these treatments available for caring for patients in hospitals, but our hospitalization toolkit is not as big as we'd like it to be. A new surge in patients could put the hospitals right back where they were just a month or so ago.
All right, Lauren, so we've got these hot spots, we have an uneven recovery, and we have some individuals who are reluctant to get the vaccine. What is the solution? Are we going to see vaccine passports? Are people going to get a little mark that they can show people to say, you know, I've been vaccinated versus those that haven't?
Yeah, I think that, well, I think the first push is to get as many people vaccinated as possible, much like we see during flu season, right? Where messaging has to be focused on helping people understand the importance of vaccine and how to access vaccine, and getting the vaccine to the people that are hard to reach, who can't just show up to a vaccine clinic or don't have access to an existing healthcare infrastructure that's providing it. So that's absolutely step one, is making sure that once everyone who's clamoring to get the vaccine is done and we have this ramp up in capacity, that we don't drop off a cliff where there's no one waiting to get it there, and we have an entirely unvaccinated portion of our population. There is some talk of immunity passports, and it's a really challenging space when we don't have universal coverage of the vaccine. So those can create inequity issues and can further exacerbate divide between people who can access healthcare and who cannot.
And there also is a concern, of course, about privacy as well. In the meantime, you're talking about the hot spots and how it's really important not to get a fourth wave, as some are fearing, with the Texas reopening. There are a number of strains that have emerged as potentially concerning based on their resistance to some of the vaccines. Which strain are you watching most carefully from that perspective?
I think the strain that was first identified in South Africa is one that we're watching because we have some evidence that it could potentially reduce the efficacy of the vaccine. And, you know, we see these variants quite often in many different viruses, but when you have sort of all eyes on what's happening with the variants and what's happening with how they impact the ability of the vaccine to work, all of a sudden everyone becomes a variant of concern. And I heard the term scariant the other day, and I think it made me chuckle, but it is an important place in where we are right now about talking about this virus. So not every variant is going to cause a change to our activities or a change to transmission or a change to our caseloads. But the one from South Africa is one I'm concerned about because of the possible impact on the vaccine.
It is going to make it really, really difficult to reopen international travel. Lauren, we always appreciate your time. Thanks for being with us early this morning. Lauren Sauer there, Johns Hopkins Associate Professor of Emergency Medicine. And just to bring you some of the numbers right now for the United States, Tom Keene, 15.6% of the population has had at least one shot. Almost 8% fully vaccinated now, 7.9%. And your average, your daily average over the last 7 days, 1.94 million, Tom, almost 2 million.
That is the good news. 1.6. Well, frankly, we didn't know what it was going to be, and then it was 1.6, John. And to me, all the study I did as an amateur on this in virology years ago and microbiology, it's incredible how this battle, as the medical pros know, is day after day after day. And that 1.9 million statistic is as important as President Biden's 300 million.
Just fantastic, considering when the president walked into the White House, it was in and around 900,000, and he was shooting for 1 million. We're close to 2. And Lisa, the concern coming into 2021 is the supply. And it looks like we've secured the supply. That's no longer the concern. This really is about logistics and the rollout now.
Yeah, and people actually accepting the vaccine, as we've seen, that's been an issue over in Europe, as you've been highlighting. Joe Biden yesterday saying he expects to get back to normal within a year, although nuancing this message. Don't get too complacent.
What is normal? What takes 12 months? Can we just start reopening again?
Really?
Can we stop the 12-month conversation?
That's what Governor Abbott's doing.
Yeah, I'm not saying do it right now. I'm not advocating for doing it right now. I just don't want to wait 12 months to, you know, board a plane, come back to New York, need to quarantine.
I'm with you.
All of that stuff.
Preach.
I'm not advocating for anything. Coming up, Greg Peters, PGIM, is he buying treasuries at 144 in 10 years?
Big question.
This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
We really do need to
rethink and, think about a new dashboard for this Fed.
It definitely was concerning to me where we saw in yields, but I do believe that this Fed is extremely committed to not hiking.
We do need U.S. real yields, and particularly U.S. front-end real yields, to stay pretty low.
I think we will see inflation settle at a notably faster pace than what we saw over the last cycle.
The overall market is actually higher than it was at this time last year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The build-up to Payrolls Friday starts right now from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene, Lisa Abramowitz. I'm Jonathan Ferro. The ADP report later this morning. Tom Keene claims tomorrow, Payrolls Friday.
Into the jobs we go in the labor economy. Of course, claims tomorrow I think will be absolutely critical, John, but certainly we see a better U.S. GDP. We see a better non-farm payroll statistic in the survey to Friday, and it folds right over to a market that has a bid and has really had a bid in the last 90 minutes.
And Tom, as you said, as we inch towards that payrolls report, that estimate creeping higher, 195, now the median view.
Citigroup out there with, I believe it's 410,000, and we creep up, and you wonder where it'll go off ADP. Mike McKee says a linkage there between ADP and jobs, maybe not so tight. And then, John, also, we've underplayed this morning, my failure. The Fed speak could be tangible.
I agree with you. We'll catch up with Mike Ferrelli of JP Morgan a little bit later for their very constructive view on the labour market through this year. But on the Fed speak, yields really violently higher in Thursday's session. We settled down. We're off the 161 intraday high. Right now, your 10-year on a nominal yield, 143, 144. But Governor Brainerd, Tom, pushed back in the last 24 hours, and maybe that helps to put a lid on things.
Exactly, and to put a lid on it's a nice way to put it, and I see it with a real yield a little bit lesser negative, a little bit higher real yield this morning. John, I want to stop things on radio and TV. I want you to compare and contrast the jawboning of American Fed speak versus the Bloomberg article this morning on ECB speak.
Well, let's talk about the top of the pile at the ECB. Vice Chair Clarida, Chairman Powell, they're comfortable with what they've seen in the last week. Granted, the move is no longer near 161, we're at 144. They call this a statement of confidence. Inflation expectations going into February were rising. You compare that to Europe. Well, Europe's got a very different problem. Inflation expectations have been going the wrong way for years and years and years and years. And the ECB is uncomfortable with the outlook, whereas the Federal Reserve is comfortable with the outlook. Why? Because the vaccine rollout has been so different in the last couple of months. So the outlook, obviously, for U.S. growth is radically different for Europe right now.
Yeah, there's also, though, a question, John, with the ECB of how much they can talk down yields, basically this idea that they don't actually have to do any bond buying. And it raises a question about the limits of what they can actually do on the ground with policy beyond just jawboning. And I think that's what it highlights.
The limits of what they can do, but also what haven't they done? Last week was just amazing for me, Tom. The ECB came out and talked up undue tightening, but they weren't piling in with bond purchases. I found that really strange. And our reporting from Frankfurt, which you touched on about 60 seconds ago, suggesting they aren't actually that concerned enough yet to act.
Just quickly, John, Francis D'Amelio, the Associated Press out of Italy. Virus variant races through Italy, comma, especially among children. Those headlines are different than Biden and 300 million.
And radically different to Governor Abbott as well. Whatever you think about what the governor of Texas did in the last 24 hours.
When's the next Texas?
That's the direction of travel in America, and that's the point you're making.
We probably have another Texas, John, by the time you get to your third property this morning.
Quite possibly. My third property starts at, I forget what time, from New York
9
City.
a.m. worldwide.
Let's get some price action for you this Wednesday morning before you and I start sparring, Tom. We look like this. Equity futures up 0.6%, positive 25 points on the S&P. We've really struggled around this 3,900 level. That'll be a topic of conversation as we count you down to the opening bell.
219 Dow.
In the bond market, yields higher by almost 5 basis points to 144 on 10. Euro dollar 120.61. We come lower by 0.2%. That's a weaker euro, stronger dollar, and dollar yen with a 107 handle. So some dollar strength out there against the yen, against the euro this morning, Lisa.
Matter again? At what point do fundamentals carry the weight that they once did? And this really points to the payrolls report that we're going to be getting on Friday. Today, those ADP numbers are a huge concern about whether this actually does cohere with what we're going to see on Friday. Nevertheless, you see that the estimates, John, as you were talking about, keep coming up as time goes on. The median estimate now 195,000. Bloomberg Economics saying 250,000 new jobs is the likely potential number that we will get today at 8:15 a.m. Also, Fed speak, Tom, you were talking about this. It is incredibly important to know what they will be responding to, what their target is, what is full employment to them, how much does the inequality in the market, in the labor dynamic really affect what they do with policy. Patrick Harker, Raphael Bostic, and Charlie Evans all speaking today on that parade of Fed talk ahead of Fed Chair Jay Powell tomorrow. And then at 2 p.m., that Beige Book report will be coming out to really highlight on the ground what we are seeing in different states. Yes, it has been a very patchy recovery. We've seen some states, Texas, try to reopen while others have to crack down on a resurgence in viruses. We will get that as I dig in to that Fed Beige Book, even though I know, Tom, you will not be reading it because you have never read it.
I just, you know, it's like, okay, it's there. The minutes I find interesting, some, several, a lot.
You enjoy that, do you, Tom?
John, is there a Beige Book with the Bank of England?
They do have the report. The agencies around the country report back, yeah. Something similar.
So, like, you know, Tottenham's terrible, they report that.
Something like that. You get the North London report on
the
Jose.
Derby report.
Back to the Governor Bailey. Yeah, we often do that in London.
We're wasting time to get to our wonderful guest.
Let's get to the question of this morning with Greg Peters of PGIM, Senior Portfolio Manager. Greg, we've been asking this all week about PGIM. Yields touching 160, 161 on Thursday. Have you been a buyer?
Yeah, so we've been poking around. I mean, it's been definitely an interesting journey, right? So, I mean, our view, you know, above 125, it gets more interesting. Kind of 150, you know, even more interesting. And then, you know, 175, very interesting. And so that's kind of how we're thinking about it from a scale. I mean, what happened last Thursday was less about kind of the level of yield, but more what happened in the market itself, right? The market really had a whiff of March 2020, where there was just a lot of dysfunction in the marketplace, tremendous illiquidity. So those are the things that we were really more attuned to. But at the same time, it has created, I think, dislocations in the curve. And so there's been lots of talk about the 7-year auction and how that tailed, and quite frankly, how worrisome that was. The 20-year part of the curve, Treasury curve, is also very interesting. So to me, maybe it's not so much about the overall level of interest rates, but really the dislocations across Treasuries themselves.
Within that, we go back to basics, Greg Peters, and there's an idea of the nominal yield, the regular yield, the 1.44% yield, folks. And around that, the dynamics of inflation and what's called the residual, which is the real yield. It's a show on Bloomberg TV. Greg Peters, which matters right now, the inflation dynamics or the residual, the real yield?
I think the real yield matters more here, as that'll actually act as a binding constraint around activity, I think, and borrowing. And so you've seen this real move in inflation, right? So inflation was priced clearly too low in March of last year. It was absolutely on the floor. So it's been moving higher ever since. But I really struggle with this narrative that inflation is really going to continue to pick up. So I'm kind of on the other side of inflation continuing to rise. Will it be around the 2% level? Yes, but it's not going to be well above. And I hate to talk about base effects, but there are real base effects coming through here that gives the optics of inflation being much higher than it really is. And the Fed is telling you that, and no one wants to listen to the Fed.
This is so important. Lisa, I can't say enough about this. 5-year forward says exactly what Mr. Peters just described.
Yeah, and that's what we've been seeing with respect to short-term inflation expectations versus long-term inflation expectations. The curve is inverted the most ever on record, which raises a question. Could we actually see 10-year Treasury yields drop to new lows at some point? And this seemed to be what Scott Beinart of Guggenheim was saying yesterday in a report where he was saying that even 10-year Treasury yields could go negative at some point. I mean, Greg, are you on that side of things, that we could see an actual rally that is pretty significant in Treasuries, or are you just saying that perhaps it's gotten a little ahead of itself in terms of the sell-off?
Well, so I'm not willing to say negative at this point. I mean, let's get below 1% and then take it from there. So I think that's somewhat heroic, but I think the direction of travel is right, but the timing's tricky. So we think the natural resting place for 10-year Treasuries is around 80 basis points. That's not to say it's going to happen over the next several months, as the forces with stimulus and just the economic rebound is so strong. But I think when you look out, 18 months, 2 years, I do really see an environment where yields will continue to kind of move lower. So timing's tricky, But I do think the direction of travel is for lower yields, not higher yields.
Greg, the South side, and this is not a diss on the South side, they often predict high yields but gradual moves. And I think on the buy side right now, there's more attention being paid to that volatility, that burst of vol we got last week in the Treasury market, and whether we see repeats of that. I think Apollo in the last 24 hours, speaking to Bloomberg about this, how to take advantage of those bursts of volatility in the future, Greg. Can you walk me through how you approached things last week and how you'd approach things in the future if you expect to see that again?
Well, quite frankly, it's tricky, though, because the markets have a tendency of seizing up. And so if there's dysfunction and dislocation in the Treasury market, which is the most liquid market in the world, in the U.S. for sure, everything sets off of that. So what we saw in March of last year was it all started with Treasuries, and then the illiquidity broke down everywhere else. So quite frankly, it's difficult to do. That being said, the derivative market is where you continue to see real liquidity in times of stress with cash. So I do think, though, if you get these gaps in trading, kind of these vacuum moves, which we didn't really see, that will create opportunity, because I think the whole world on the buy side is waiting for credit to cheapen up, because the strength of the economy is such where you really want to own it.
Greg, always good to see you, sir. Greg Peters, PGM Senior Portfolio Manager. Didn't say whether he was buying Tom Keene at the long end. Poking around.
That's what they do.
I'm not sure
poking around. That's CFA talk. Come on, John.
Come on, I mean,
is that
he's
buying?
buying.
Is that buying?
Greg,
They're
he'll
not
come
allowed-
on next
First
time.
of all, he's
Thinking
not
about
allowed
buying.
to say. His general counsel will, put him in the timeout chair, the PGM timeout chair, if he's out there saying buy or sell. I do want to point out, he does mention the real yield, folks. That's not the statistic, USGGT 10Y, whatever it is. That is the real yield show. Look for the real yield. You can see that Fridays, 1 p.m. And then, importantly, through the weekend, as you get ready for the second week of March, look for that on carefully selected networks worldwide. John?
This always scares me. I wonder what I'm returning to at my desk after the show when you start promoing real yield
Tom's
2 days
poking
early.
around.
What have you done? I always think the same thing. What have you done?
He's poking around.
There we are. Corpus Christi, Texas. Thank you for listening. They don't agree with their government. Just one opinion,
you
John.
move it on.
Corpus Christi says no. It's politics over
I can't wait for
intelligence.
10 Eastern.
They're wearing a mask.
Coming up at 8 a.m., Alicia Levine, BNY Mellon Investment Management Chief Strategist from New York City this morning. Good morning. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. The Senate may formally begin debate on the pandemic relief bill as soon as this afternoon. The House has already passed the measure. Now a handful of moderate Democratic senators wants tighter targeting for jobless aid and stimulus checks. The Biden administration isn't counting on any support, so it needs all 50 Democrats on board. It's President Biden's first major setback in filling his cabinet. Neera Tanden asked to withdraw from consideration to lead the Office of Management and Budget. Senators had objected to her partisanship. Tanden led the Liberal Center for American Progress for almost a decade. And in the UK, Chancellor of the Exchequer Rishi Sunak will extend furlough payments to workers through September. That will protect millions of people whose jobs have been suspended during the coronavirus pandemic. The British government will keep paying 80% of wages for those in the programme through June. That allowance will decline over the following 3 months. The Tokyo Olympics organisers say a decision will be made by March 25th whether to allow overseas spectators. They'll decide whether there will be limits on Japanese fans in April. Earlier, the Mainichi newspaper reported that foreign spectators would be banned from the games. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Nuestro país, igual que los demás países del mundo, no está preparado para esta pandemia. Más aún, los más afectados son los países de desarrollo como el nuestro, ¿no?
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
More and more people are starting to look at the wealth tax and say, wait a minute, this makes a lot of sense. You know, people across this nation get it. Independents, Republicans, Democrats, a majority of all of them want to see us do a wealth tax because they know that the system is rigged against them.
Senator Elizabeth Warren, the Democrat from Massachusetts, speaking to Kevin Cirilli in the last 24 hours. More from Kevin in just a moment. From New York City this morning, good morning. Alongside Tom Keene, Lisa Bramwitz, I'm Jonathan Ferro. Live on TV and radio, up 22 on the S&P 500. We advanced 0.56%, just south of 3,900. The ADP report comes in about an hour from now. Then it's claims tomorrow and onto payrolls this Friday. In the bond market, Tom, just to wrap things up for you, curve a bit steeper, 2s out to 10s. Yields higher on a 10-year by 5 basis points. 144 is your yield right now.
John, small caps lead out. Russell 2000, 1.1% there is, well, I call it a churn, folks, but within the range of the tumult of the last 10, 20 days. Victory lap for Kevin Cirilli, a smart interview with the progressive of the moment, the senator from Massachusetts, Elizabeth Warren. What was the biggest surprise, Kevin? Let me cut to the distinction you saw in the senator's comments.
Two things. First and foremost, the space that is between Secretary Yellen and Senator Warren, and that's only going to be continued to be explored both in the financial services press, but also as we inch forward and beyond President Biden's first 100 days. But then secondly, there's a co-sponsor that we've all spoken to, Congressman Brendan Boyle. He represents suburban Philadelphia. He is seen in many ways as a moderate Democrat, and he's a co-sponsor of this bill. It's Pennsylvania, a battleground state, so there's political long-term implications. But also, again, it speaks to this broader point about how her ideology is now really shaping suburban congressional districts in a way that in 2013, her first year in office, we didn't see.
I want to dovetail Senator Warren's comments with the reality as seen in Greg Vallier's notes this morning, which is the battle of 2021 is a redistricting. You talk about Pennsylvania, your Pennsylvania, Kevin. It's really always legal, always bitter, a battle. Can the Democrats lose the House just off of redistricting?
Well, they're they will say that redistricting poses a significant opportunity for Republicans. Republicans would take issue with that and say that it's because typically the mood of the country and the pendulum, the political pendulum, swings back and forth after a couple of years into someone's first term.
One thing that was really clear to me about Senator Warren's interview with you, Kevin, was the increasing gap between the Biden administration and what they're trying to do and the more progressive wing of the Democratic Party. And I'm wondering how much this fissure is going to jeopardize Biden's plans, both with infrastructure spending and some of the other provisions that he's talked about.
You know, it serves as a check and a balance because they lost the progressives lost the minimum wage debate, likely on $15 per an hour. But when I asked her point blank to respond to Senators Sinema and Manchin, she took an opportunity to talk about the filibuster with Mitch McConnell. And the reason I bring that up is because on the one hand, what the progressives and Senator Warren are doing is saying, look, we want to continue to hammer this administration on progressive policies. But on the other hand, she's not taking the opportunity to criticize members of her own party in her caucus. That's a very nuanced political strategic move from the senator from Massachusetts.
Okay, so perhaps there is some nuance here, but can we sort of extrapolate out and say that those tax hikes that people were thinking about pre-2020 in the election and talking about Democrats gaining the majority, that's back on the table, that there could potentially be some tax hikes that we're talking about later in the year?
Yes, and she's not bluffing when she says that there are Republicans who are considering siding on to this proposal as a co-sponsor at all. And when you go longer term, especially when we talk about infrastructure, and President Biden and Secretary Buttigieg are going to be having a bipartisan meeting with members of Congress tomorrow on infrastructure, they have to figure out a way to pay for it. She's coming out first and saying this is how you do it. So whether or not that continues to be discussed, and Republicans view this ultra-millionaire tax as a mechanism for revenue, for funding for infrastructure, that's the part that we don't know. But I can tell you this, you look at the polls, and there's a Reuters Ipsos poll out yesterday, 53% of Republicans agree, earlier this week, not yesterday, 53% of Republicans agree that with this ultra-wealthy millionaire tax, that's very different than being able to say, well, raise taxes for folks over a certain threshold of a couple of $100,000.
Well, this is about redistribution, and the relief plan is also about redistribution. Let's be clear about that. They believe, most people assume, they can see it in the data, that we have a K-shaped recovery. We've all talked about that for the last 12 months, and this administration wants to do something about it on both the spending side and on the tax side of things as well. So, Kevin, let me ask you this. Is the primary objective here to fund infrastructure spending or close the K?
Well, I think it's a little bit of both. And look, I mean, the wealth inequality is the point that progressives continue to make here. And especially, 1 year into a pandemic, progressives are raising the issue that, there have been the data would suggest that the lower income and lower net worth individuals and minority groups really suffered the most economically during this pandemic. And so this is a conversation 1 year later, similar to the populism that we saw after the 2008 financial collapse. Now we're at the start of a new conversation about how to get moving again. And so I would expect also Republicans to come out and say we need to reopen, we need to lower taxes. But here we are again in the aftermath of another economic collapse.
Kevin, got to get one more from you. The administration's response to what happened in Texas with Governor Abbott.
Well, I'll have to get back to you on that. But I think as it relates to Texas and Governor Abbott, stay tuned.
Stay tuned. Kevin, thank you, sir. Kevin Cirilli, Chief Washington correspondent and host of Sound On.
See, this is the problem, John. You and I have been up since 3 a.m. Cirilli saunters in at 7:20 and doesn't have the answer,
What can they do about it? And the answer to that, Tom, is nothing.
He's up an hour and a half earlier than everybody else down there, so he's killing it, I guess.
The answer is nothing, Lisa.
Well, and the reality is, I mean, we already know what Joe Biden is going to say, right? That basically we need to be really cautious and that we need to go tread lightly. I mean, he's going to want to push back to some degree, but also highlight that he is moving forward. I mean, this is the delegate dance we heard yesterday, John.
Yeah, I think they can get ahead of this, though, at the federal level. I think the government could come out and say, this is what we recommend should happen if you've been vaccinated. I think they need to do that and do that pretty soon. Most people are asking the same question.
Well, but the science doesn't necessarily back it up just yet, right? I mean, there could be a possibility of transmission, and they're just wanting to be super careful about that. But you're right.
Yeah, but John, I was in a restaurant the other day, and I was deciding between the #2 value meal or the double cheeseburger, and they were talking about they're going to move gradually out from 25% seating. Texas didn't move gradually.
There's no way it was McDonald's.
I can't take you seriously. I've been to McDonald's with you once at Liverpool Street in London.
Really? I don't remember that.
That was the one time we went. That was it.
And did he know what to order?
No, I had to order it for him because it was after a long. It was after a long
This
late
was
night.
true story, folks. For those of you on radio and TV, this is at the Liverpool train station in London, and the only reason we went was to get a photograph to prove to Bloomberg I was within the expenses that had been dictated to me. Dictated, I say.
What about the bill before the McDonald's?
Well, that was cocktail
Which was the drinks bill. Coming up, Jane Foley, Rabobank head of FX strategy from New York City this morning.
Dictated.
Good morning.
$4 a day.
Yeah, this is Bloomberg.
CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
From New York City, this is Bloomberg Surveillance for our audience worldwide, live on TV and radio. Here's the price action this Wednesday. Bit of a bounce back on the S&P 500, up about 0.6% on the Nasdaq right now, up by about 0.5%. The outperformance on the Russell, the small caps, up by a little more than 1%. Tom Leiter and I talking about this through the morning, the challenge of being at 3,900 and just chopping around that number right now. Here are some numbers to think about: 27, 10, and 11. I'll go through them, and we'll start with 27. 27%, that's the weighting of big tech, technology stocks in the S&P 500. Why are they getting smacked around? Here's the why. Switch up the board into the bond market. Talked about this repeatedly over the last week or so. This is the nominal yield, 2s, 10s, 30s, your 10-year, about 144, call it 145, and up about 5 basis points on a session. Those growth stocks have been challenged as the real yield, not the nominal yield. The real yield has really started to push higher and bite into those valuations. It makes it difficult for the S&P 500 to advance. Difficult because big tech is constrained even as financials rally. So switch up the board and finish on this. Here's the 10 and the 11 piece. Here's the 10 piece. If you look at Amazon and Apple, that's 10% of the S&P 500. This is the performance on the month. Down 6.6, down 6.6. That's over the last 30 days. Where's the 11? 11% is the weighting of financials. And that's the challenge here, Tom. Two names, Apple, Amazon, down 6.6% over the last 30 days. Even with financials trying to do the lifting, it's a lot of heavy lifting because they are only 11% of the S&P 500.
And John, this goes to the
rotation.
That 10. John, this goes to the rotation debate. Is it a rotation or is it just the things on the mat, off the mat, back up to normal?
It's a rotation right now. And the problem for the S&P 500, if you're looking for a higher one, you don't necessarily need these names to advance, Tom. You need them to stop going down.
Yeah, that's well
the
said.
challenge
Well
right now.
said. Well, that's really important concept.
So that's the story right now in the market. For more movers, let's get to Romain. Morning, Romain.
Yeah, good morning, John. Definitely a bit of rotation, although it's a little bit of kind of a circular action too here, kind of going around that merry-go-round. All the talk, of course, over the last couple of weeks has been about that narrowing risk premium. That's been the talk this week. But the problem is, John, with all that talk here, there's no real consensus on it. You saw that reflected in the rally that we had on Monday, and then, of course, the sell-off that we had on Tuesday. And then here in the pre-market, you're kind of getting a taste of that again, this lack of consensus here. Tech is trying to sort of dust itself off and reassert itself. If you're looking for signs of life in that, you can keep an eye on what's going on with regards to the semiconductor space. We have American Tower on there. I meant to put Applied Materials. That might have been my typo there, but the semiconductor equipment stocks are trying to sort of reassert themselves this morning. And the interesting thing about it is when you look at the value trade versus the momentum trade and the sort of push-pull between those two, it all, of course, then comes back to yield and what you're getting. The resiliency we have seen has been in that chip space. That's been the outperformer in the tech space, outperforming software, hardware, and everything in between. The fintech stocks like Square have also been outperforming. Remember, Square bucked the trend yesterday. They didn't sell off. They were up 5%. Their third straight day of gains. They're going to be up here if these gains hold here in the pre-market. And then, of course, you have the hope floats trade going on with rocket companies. This was started off again.
Right.
So similar to GameStop, there was a fundamental story here of why we saw a rally in this stock coming out of its earnings last Thursday. But of course, what we saw yesterday, where it just popped 70+% during the normal session, pretty much had no explanation. But again, you could call it a short squeeze. You can call it a return of the meme stocks. But again, this goes back to the talk, the chatter, and the general idea here that you really don't have a consensus, Tom and John, as to sort of where this market should be.
Where's the short interest on GameStop right now? Do we know?
I don't know off the top of my head. I mean, right now we were looking, I don't know. So let's just put it that way.
Tom, did you see Hertz yesterday? Hertz, the ultimate meme stock, that it came out and actually had a reorganization plan.
How much are those shares worth, Lisa?
0.
Oh.
And they had been up beyond $5 a share. Just pointing that out.
Can you believe they almost did an equity offering? Last year, and that was unreal. Romain, before you go, I just want to jump in quickly. The big turnaround story in yesterday's session, and it wasn't in the morning. When you were here with us in the morning, Zoom was flying.
Yes.
By the time it got to your show in the back end of the day, Zoom totally rolled over. What happened?
You're blaming him?
It's all about the growth story. Again, you're talking about, look, they're talking about their forecast for growth. They're coming off 300+% growth, right? Their forecast for Q1 is 150%. That drops to like 40% in the next quarter. By the time you get to the fourth quarter, analysts are modeling, believe it or not, close to single-digit percentage growth, and this is on revenue. And this is really the story here, is that the comparisons now you have for companies like this are just going to be too difficult to really satisfy the valuations that are out there on these stocks. And if there's any stock that has a high valuation, I won't call it overvalued, but hi, it's Zoom.
Futures dip with Romaine Bostick. Thank you so much.
Thanks,
On the
Romaine.
close this afternoon, futures up 20-something, now up 18 points as well. Jane Foley joins us now with Rabobank, very astute on foreign exchange. Jane, I want to introduce how we've gone nowhere. I think a lot of our listeners and viewers don't know this. If you look at trade-weighted dollar, if you look at the real broad index of the dollar, it's basically been range-bound for 3, 4, and even out 5 years. It's gone nowhere. Does that surprise you, or can the dollar finally cut one way or the other?
Well, you know, Tom, maybe we've gone nowhere on that measure, but in many respects, we have gone everywhere. There's been a huge amount clearly in the global economy. And I think right now, we've just been hearing in the equity space that there's a lack of consensus. There's a lack of consensus with respect to the foreign exchange market too. And that means that there's an awful lot to resolve in the coming few weeks, the coming few months. And that might mean, I think, a fairly choppy backdrop for the dollar and really for the foreign exchange market in general, as the market comes to terms with these new themes. The theme, for instance, of reflation. A couple of weeks ago, the market thought, well, you know what, that means that we're going to be buying up high yield, buying up emerging markets. But recently, the market's been thinking, well, you know, reflation's centric to the US. What does that mean for Fed rates? Well, if the Fed rates are potentially going to go up a little bit sooner than the Fed is thinking, well, surely that means that perhaps the dollar is going to be a little bit more resilient than the market is expecting. And that's the theme, I think, that's coming through. And that's the theme that's got to be resolved in the next couple of weeks, or perhaps actually maybe even the next couple of quarters.
Jen, I'm trying to work out where to play that through G10 right now. Is it through the low yield? Is it through the commodity currencies? How do I push that view through?
Well, you know, I think if we imagine that the market is still pretty short positioned on the dollar, I think we might be seeing that coming through, and perhaps a better tone of the dollar. Now, that doesn't mean to say that we're not going to see these flows into high yield. We're not going to perhaps see that the commodity currencies going higher. I'm not saying that, but perhaps we're not going to see as much gains in high yield, as much gains in commodity countries. Maybe, for instance, for the Australian dollar, to take that one, that's a commodities one, that's generally a little bit high yielder than within the G10. Maybe, you know, that is going to push against the recent highs that we've seen, find it quite difficult to get beyond those levels. And I could say the same really for euro dollar too. Maybe that's going to find it difficult to get to that 125 level so many people in the market have been talking about. That now looks to me quite a long way off. And in fact, we could see a little bit lower potentially in euro dollar over the next 6 months or so.
Just seems to me then, Jane, you think the sell-off is done. The dollar weakness story that people expected to develop through the year ahead won't develop.
I think you're right. I think that's quite true. That isn't to say that we're totally resolved with this story. Yeah, I don't think we are. For instance, if we look at what Brainard has been saying and the Fed, you know, she's talking about the weakness in the labour market. We've seen that, of course, across other G10 economies too, and elsewhere. She's talking about a 23% unemployment rate in the bottom quartile of workers. And we've got to remember that when we're talking about these savings ratios, we've got to remember that much of the savings has been done higher income workers, and they have a low propensity to consume. So the Fed's not going to give up on its dovish tone yet, and nor are many of the other central bankers either. So from that point of view, there's a real battle, I think, going on between what the market thinks will happen and the Fed wanting to say, look, you know, hold your horses, you know, give it time. So I think in this scenario, as the market sort of resolves or tries to resolve what this all means, I think it's going to be choppy.
All right. So choppy for the foreseeable future, not necessarily a big weakening or a big strengthening of the dollar, and sort of less commitment in the high-yielding space. What could you see breaking us out of that? In other words, what are the risks to either push the dollar substantially stronger or substantially weaker and entering a new cycle of trading?
Well, I suppose that we've got to come back to the risks with respect to the vaccine, the risk related to COVID and coronavirus. Hopefully we don't get bad news on that front. Hopefully it carries on being positive. But, you know, the market has still got to get through the tail end of this pandemic. And that means that a lot of the economic data over certainly this quarter and maybe going into Q2 could disappoint. So again, the market could be disappointed that the Fed appear to have the upper hand with its dovish scenario. That could again bring back some of the scenarios in the markets that we were talking about earlier on in the year. And then perhaps as we get into the middle of the year, we're going to have finally, you know, much more confirmation of the better outlook in growth. So I think it's going to be one way or the other. I think first of all, we'll have these discussions on growth. And then finally, maybe in the second half of the year, we'll have a lot more conviction about the reflation trend.
I know that John Farrow is prepared to give us all fantastic gifts because of the strength that we've seen in the pound. We're seeing 139.65 right now. And Rishi Sunak just coming out and saying that he expects the UK economy to return to pre-COVID GDP by mid next year. Do you see more upside to the pound?
You know, I think a lot is priced in with the pound. Now, particularly with cable, if we do get this better tone, this more resilient tone of the dollar through, then that could make some more significant gains in cable a lot more difficult to achieve. So for now, I think we're on perhaps a consolidation phase, a choppy consolidation phase. I think, you know, the 142 level could be quite a long time coming potentially, but you know, again, this very much depends on the data. The market now is a bit longer of selling, and that means it is going to be more susceptible to falling over if we do get bad data. And we still have the possibility that the data prints that we get for this quarter could disappoint, because after all, we are in, you know, pretty tough lockdown over here.
Jane, great to catch up. Jane Foley, Rabobank Head of FX Strategy. The Chancellor in the UK, Rishi Sunak, speaking right now. Here's some forecasts out of the UK at the moment. Get your head around this. 2022, the economy will grow by 7.3%. Here's the number for 2023, Tom. 1.7% for 2023.
Yeah.
You compare and contrast those 2 years, that deceleration, that's back to trend growth really quickly. And this will be the story that central banks will try to tell as well. Yes, we are going to get that explosive growth in the near term, and then we flatten out, and flatten out fast.
I would look at the 2023 number is just a sort of an extrapolation back to potential GDP. And that may happen, it may not. I mean, what do we know? The thing I would notice right now is Q1, they take down to 4%, John, which shocks me on a relative basis versus U.S.
Here's the other line from Chancellor Sunak that I think stands out, and a lot of people in the UK familiar with this commentary. We'll need to begin fixing public finances. The UK has been one of the only, I think, developed economies, Tom, that has come out repeatedly and talked about this. And I just wonder if that's a mistake. Too soon to start talking about tightening things up. Recovery has really got underway.
139.73 on sterling, down from the last few days, John.
From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. With your equity markets struggling around 3,900 on the S&P, we do advance this morning, though. Up 18, call it 19 points higher, up 0.5%. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. President Biden wants to speed up the timetable for most Americans to be vaccinated for the coronavirus. He says there will be enough doses for all American adults by the end of May and wants states to give teachers and childcare workers priority. The president wants them to get at least one dose of the vaccine by the end of the month. U.S. infrastructure has received a mediocre grade from the American Society of Civil Engineers. That should help President Biden when he asks Congress for a major infrastructure spending package. The engineers group says roads, bridges, sewers, and the energy grid remain underfunded. And more problems for New York Governor Andrew Cuomo. Legislative leaders have agreed to curb Cuomo's pandemic-related emergency powers. That comes on top of calls for Cuomo to resign. He's facing an investigation into claims that he acted inappropriately towards 3 women. Plus, there are questions whether his administration covered up data on coronavirus deaths in nursing homes. And OPEC and its allies are set to cool off that rapid rally in crude oil prices. The OPEC Plus coalition is poised to agree on a production increase at Thursday's meeting. The usual differences are present. Saudi Arabia is cautious while Russia wants to open the taps. Still, all sides are ready to pump more oil. Samsung has outlined plans for a $17 billion semiconductor factory in the U.S. The plans were filed with Texas government, although Samsung also is considering sites in Arizona and New York. The South Korean company is trying to win more American clients and narrow that gap with the industry leader, Taiwan Semiconductor. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
80% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
The next 3 years are going to be the fastest 3 years of oil demand growth since the 70s, simply because we're coming from a very low base. But if we overshoot, that's where I think the upside risk over the next 3 years could be up to $100 per barrel.
Triple-digit crude, that's the upside risk. That was Francisco Blanche there of Bank of America, the head of global commodities and derivatives research from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Crude this morning, WTI 60.60 on Brent 63.50, up by 1.4% on WTI crude here in America. In the bond market, yields are higher by 5 or 6 basis points now, approaching 145 on a US 10-year, and the bid stays in equities, Tom. The outperformance, as you mentioned, coming from the small caps, the S&P 500 futures there, up 0.5%.
Yeah. Little ebb in the last 20 minutes or so, but we're monitoring this lift to the market within the ranges that we've seen recently. To all of you on radio and television, this is a wonderful joy. Oswald Clint is with Sanford Bernstein, and their research, the Black Book, if you will, the traditional Black Book on hydrocarbons is treasured. He is a geophysicist from UCL, and we're thrilled he could join us today. Oswald, the acuity of your work, the precision of your work, leads to hyper-careful analysis of demand. What's the demand recovery look like right now?
Well, thank you very much for having me, everyone. Demand, yes, critical. Normally, we spend our time analyzing supply because that's where the data is most opaque and we can add value. Demand is as you say, tracked much better these days with all the mobility indicators.
Yeah.
Our view, our view is that Europe is a weak spot. Remember, Europe's 15 million barrels a day of oil demand, 15% of the pie, and this is where it's worse. I mean, North America's powering ahead. Asia is really coming back strongly. It's here in Europe that we need to get back up and running.
Okay, I want to take your landmark research and dovetail it into 300 million vaccinations. What's the elasticity of the oil price to get up, move up, and even outside of your range 60, 70, based on Joe Biden's 300 million vaccinations?
Well, I mean, U.S. is like 20 million barrels a day, fell to 18, goes up to 19, this year, and then back to 20 by next year, 20 million barrels a day. So that, that kind of matches a little bit your vaccination rate. Remember, the U.S. was on a bit of a decline curve in terms of demand. So we're not expecting huge growth beyond 20 million barrels per day. Remember, the more important question, Tom, is what is the net zero strategy that could be outlined, and how much oil demand does that take out of the system on a go-forward basis?
Oswald, you're running us through some really important numbers. I think quite often we have a bias here, in America especially, to look at the commodity market and look at what's happening around us in the US economy and say, this is the direction of travel. But when you mention Europe struggling, China, the recovery there, really maturing now, it's flattening out. It's not rolling over, but flattening out, Oswald. When you put that all together, is that why you are, let's say, less bullish, the commodity market right now?
Yeah, I mean, you're right, Jonathan. It's a bit of a short term. Did we think $60 in the first half of this year? No, we thought 50 because of European demand weakness. However, inventories are pulling back swiftly, and it's a little bit surprising. Now, that's good, but it's surprising. If OPEC adds back more supply tomorrow for the next couple of months, we probably would pull back, in terms of the short term. That's why we're a bit more cautious. But longer term, that demand going back to 100 million barrels a day, going up 1 million barrels a year for the next couple of years. But the supply side is really, as I said earlier, is really more important. That will struggle from this point onwards. And therefore, prices can go to much higher levels than we're looking at today.
Often important to think about crude and these kind of things in a range as well. When you think about the range right now, just not a dot on the screen, not a price target, the range at the moment going forward, what's the appropriate range to think about?
I honestly think a good $60 to $80 a barrel Brent is a good range. I think above that, we'll get discipline breaking down. I think, to Tom's point, elasticity kicks in and people spend more, travel more, buy less, and it starts to see demand destruction. Plus, in this day and age, you'll see way more substitution from wind and solar and hydrogen, because the economics will tilt into those, and you're causing that demand peak point to come earlier. So we don't want to go to 90, 100. I don't think if we went there, we'd go there for very long. But I think 60 to 80 is the right number for OPEC and for producers who are left in this market.
Maybe 5 years ago, Oswald, people talked about how the swing producer there, the swing driller, was really the shale complex. And people would say that's the big unknown. Okay, OPEC can come to some conclusion, but what's the U.S. going to do? And it isn't included in these agreements. Does it still act that way, given the fact that the economics are a lot less favorable in order to drill at these price points?
Yeah, great question. I mean, think about it. 1 million barrels a day of U.S. output over the last decade, 1 million barrels a day per each year. So 9 or 10 million barrels a year per decade. Going forward, though, to your question, that number, at least at the base case, is probably only 0.3 million barrels per day each year. So it's a third of its former glory. And that type of number should not be disruptive, hugely disruptive to oil supply and demand balances, as it has been over the past 10 years. So yes, they've got some growth. To your point, a lot of the good locations have been drilled. The low-cost locations have been drilled. You need higher price decks in order to drill more, but the quantum will never be, it'll be a shade of its former glory.
Oswald, good to see you, sir. Thanks for your time. Oswald Clint there of Sanford Bernstein. And I think we need to think more about that range, Tom, particularly the top end of it at $80, when the demand destruction starts to kick in and the lean towards the alternatives kicks in as well. And let's be clear about that. OPEC Plus has no incentive to allow it to go in that direction.
It's a little confusing for listeners and viewers, John, and that some people take a more macro view, a bigger cosmic nation-to-nation view, and others go really into the microeconomics. And then some people do both, actually, like I'd say Francisco Blanch. I mean, Dr. Clint is just world-class in that microeconomics of supply and demand of oil, and that gets him to that range.
Crude with a little bit of a lift, Lisa, 63.58 on Brent, WTI 60.68.
But you highlight the tension here with the OPEC meeting coming up tomorrow, this idea of not wanting to increase production too much, right? They don't want to cannibalize too much from the riches that they're getting with prices going up. And at the same time, if they don't produce enough, prices go up too high, that's detrimental on a longer term level. This is a really delicate dance they're doing.
This is one example of the delicate dance, so to speak, to borrow your phrase, the tug of war between policymakers and markets. Markets will front load a lot of this very quickly. That's what we saw in the bond market last week. This is what policymakers don't want, Tom. They don't want markets to front load the growth over the next 12, 18 months because the recovery hasn't even started just yet.
Yeah, I'll go with that, John. But, you know, I look again at GDP right now in the mood. And, John, I'd go back to the blunt instrument of 70% of the economy is consumption.
Yeah.
And frankly, here's the point of debate for the show, is the next retail sales report more important than the next jobs report?
Tom, it depends on what the stimulus checks look like, because that's what's dictated how strong that retail sales report has been. Just the disruption from policy to traditional labour market indicators and what they mean for the broader economy, I think has been one of the big stories of the last 12 months for this market. Coming up, Alicia Levine of BNY Mellon on this equity market. As we struggle to break 3,900 and stay there, we have a lift this morning, up 16 points on the S&P. We advanced 0.4%. You have a lift in the bond market too. Treasuries lower, yields higher, up 5 basis points to 1.4463%. From New York City, heard on Bloomberg Radio, seen on Bloomberg TV, this is Bloomberg Surveillance.
What kind of leader are you?
I'm a leader that works on figuring out destinations that we should aim for, and then chooses the direction.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. visit Bloomberg.com/webinars.
We really do need to rethink and, think about a new dashboard for this Fed.
I think we will see inflation settle at a notably faster pace than what we saw over the last cycle.
There are real base effects coming through here that gives the optics of inflation being much higher than it really is.
The overall market is actually higher than it was at this time last year.
It's not a straight line higher. The year finishes pretty good, but there's a good correction along the way.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television this morning. Futures up 17. It is Bloomberg Surveillance. John, I want to go right away to the bottom line, the fundamental of this year. Simon Kennedy kills it with a must-read for Bloomberg on $2.9 trillion of summed global created in the pandemic cash. That's unreal.
It's a data point morning as well, Tom. An ADP report just around the corner, then claims tomorrow and payrolls Friday. And the expectations for this economy as the year grows older get greater and bigger and greater and bigger.
And fueling that pandemic hoard of $2.9 trillion, John, is the movement we're seeing in the jobs report, moving from, what was it, up to, we're not up to Citigroup yet at 400,000, but the numbers are, the guesstimates are moving in the right direction.
Median's 200K, and we need it much higher than that. And we're going to catch up with JP Morgan a little bit later this morning, Tom, who are looking for numbers much, much higher than that as the year progresses. But the reopening begins, whether you like it or not. Governor Abbott reopening Texas, Tom, and that's going to be the direction of travel. Most people think for more states still to come as the year progresses.
Michael Ferroli to join us here in a bit. Lisa Abramowitz, John mentions Texas. We've already had people watching, listening in Texas come back and say they don't agree with their governor. Think of the pressure, Lisa, on Florida and other states of the same political mind.
Everyone's sick of this. I mean, everyone wants it to be over, but just wanting it to be over isn't enough. And there's sort of a question, and Lauren Sauer highlighted scariants, this idea of these variants that are coming out and could potentially be resistant to the inoculations. How much will that fuel some of the public pressure to keep things closed?
And John, what's so important within the Simon Kennedy tour de force are the charts that show the abrupt shift in cash that's out there. And do we all agree, John, I'll start with you, that the mystery here is the timeline of that use of cash? Is it 1 quarter? Is it 1 year? Could it be 5 years of oomph?
Yeah, not just the timeline, though. I wonder where the money goes. And Lisa's been on top of this point over the last couple of months, Tom. Yes, we do have a lot of savings. And yes, there is a lot of money, a lot of cash in money market funds. But where's the savings coming from? Is it coming from the direct aid, the checks? Is it coming from people who have saved the money because they can't engage with services in the way they could more than 12 months ago? Or is it because there's some debt out there, Lisa, that hasn't been paid?
Well, yeah, all of the debt moratoria, the idea that people deferred all of those rent checks, that all is going to get paid back with some of this savings. There's also a question, though, of whether people will deploy it, whether they'll be secure enough in their job prospects once the stimulus has abated to go out and actually spend. And then what are they going to spend on, Tom? Are they going to go out and get, go have dinner? Are they going to go get haircuts? Are they going to go get their nails done?
They're just going to do what they do within the microcosm. But to your point, we're going to grow our way out of this is the optimist belief. And certainly the optimists here buttressed up against record highs. Let me do data very quickly here. Futures up 17. Dow futures up. John Farrow, 160 points of VIX. 22 handle earlier, 23.30. John, in the yield space, I've got some movement. 6 basis points in the 10-year yield.
Yes, a lift at 145. And you know what happens, Tom? If equities are up and bond yields are up, it's the right kind of lift in bond yields. That's the story, isn't it? The right kind of lift in bond yields this morning.
A 3-hour simulcast. We want you to tune in on radio and TV for all 3 hours because John covered this very much so in our first hour this morning. John, I'm also looking at foreign exchange. I got some dollar strength. We saw that 107 print, weak yen.
Dollar yen through 107, euro dollar breaking down. Let's get to Alicia Levine, Bank of New York Mellon, chief strategist, joining us now. Alicia, great to catch up. Let's just start with the S&P 500 struggling at 3,900. What's going on?
Well, what's going on here is the rotation trade and higher yields and a steeper yield curve, because the sectors of the market that are outperforming and are quite strong are not the ones at the top of the index. So all those large cap tech stocks have really peaked out on a relative basis in the summer of 2020. So as they struggle, the index itself will struggle, but there are plenty of sectors and plenty of companies that are doing great year to date that are having very clear bull markets. And as yields move higher, and as we have expectations for higher yields, the tech and the growth sectors, as large cap names that really led last year, are going to struggle. They're just going to struggle, and that's affecting the index.
Alicia, you do the macro micro with such acuity. I want you to dovetail the easy call on the macro with the reality of micro adjustment down the income statement. Are we at the edge of too good to be true?
So that is the great question. I think this year we're going to see a little bit of a bifurcation between Main Street and Wall Street. And last year was an amazing year for Wall Street and for asset classes because we sat on yields. And this year, it's going to be a very difficult dance for the Fed, and actually a very difficult dance for the bond market. Because if we actually print 10% quarters of GDP, a couple in a row, double digits, which I think could happen given the spending and consumption numbers we're seeing, I think it's going to be very hard for yields just to sit there and for the market to believe that the Fed isn't going to move sooner. That's the dance that the market has to absorb. We do think that the economy will reopen. You can feel it everywhere, even in the middle of New York City, where I am. You know, you feel it happening. Spring's coming. People are getting inoculated, and it's happening sooner than I think we had hoped for 6 weeks ago.
Alicia, Robert Schiffman over at Bloomberg Intelligence does a brilliant piece today on how tight the big tech bond credits are. They're shockingly tight. Surprisingly, Amazon actually doing, on the edge of Apple in tightness as well. They're up to their eyeballs in cash. What do they do with the cash? And particularly across the market, what do they do with all the new cash?
Look, that's a great question. We think overall in the aggregate, with all the new cash that's raised, you are going to see a lot of M&A, which will help support markets here. But I think ultimately, the cash is going to be used for buybacks and things like that, and investment, because this is a great investment year for those companies that have large cash surpluses. Change the business, grow the business, add businesses. This is really the way to use it to look forward. We're kind of concerned about those favorite names that supported all of us last year during the misery we all experienced. It's kind of clear that the growth year over year is going to be slower this year, and I think those names are going to struggle. We love energy. We love financials. Invest with the yield curve. Think big. Big economy, boom in the economy, yields moving higher, and pick those old economy stocks that everybody gave up for dead for years and years and years. Value hasn't outperformed since 2007. There are many investors who don't remember a time when those stocks in the old economy actually worked and gave you performance, and here we are, and it's working. Not to mention the underallocation to energy across the investor space because of ESG concerns and investor concerns. I mean, this is the sector that's outperforming and underowned. There's your pain trade.
Alicia, I don't want to say that I'm Debbie Downer. Again, I go back to trying to see around corners because I think that that's sort of more how I'm playing this. But let's say the consensus is wrong. And let's say yields, instead of rising, fall. They fall to 80 basis points, as Greg Peters of PGIM was saying, could very well happen earlier, as we've seen Scott Minerd of Guggenheim say that he could see yields going close to zero next year on the 10-year Treasury. Let's say that the structural story here of an aging demographic, of slow growth, reasserts itself. What happens then? How violent could the move be, given how crowded this consensus that we see today in the market really is?
Look, that's really the left tail risk, and it could be a violent move down. You'll see a rotation very quickly back into those defensive favorites of large cap growers and tech. But also, but that is really the risk here. The variance. Whoever invented that word was the scary variance. That's really the risk, and also that there's stasis within the labor market, and that bottom 20% that has really been affected by unemployment and the closing of the service economy doesn't really quite come back. So maybe you get 50% of those jobs back, maybe 75%, but what do you do with the rest? And it's very clear that retraining is not something this country does very well on a short-term basis. So then you do have a permanently unemployed. That is the risk here. We do think, though, there's so much forward momentum in the next few months, and I think the desire to engage with the service economy is palpable, it's real, and so I'm pretty optimistic about what happens with the labor market going forward.
Alicia, love catching up with you. Alicia Levine there, Bank of New York Mellon Chief Strategist. So just before this segment started, we talked about high yields in an equity market, and if yields are up and stocks are up, it's the right kind of move. Well, equity futures are rolling over now. We're up by around about 9 or 10 points, up 0.2%. You can see this in the intraday chart. It's the move in bond yields, Tom. We're up 7 basis points now on a 10-year to 146, up about 7 on 30s to 226.
And John, as importantly, in the 2-year space of 0.1309, I don't have the chart up. I haven't done the work on the 2-year yield now, but you're right. There's a lift here, and I just don't buy the micro analysis tick to tick. I would look at this much more as range bound, waiting to see the mood, the economy, going back to the first, second week of February.
What do you think, Lisa?
I'm just looking at the move right now in 10-year yields and wondering what spurred it. I'm actually looking right now for the economic data because it actually is a leg higher, and you are seeing that direct correlation. Look, there is a concern about valuations. How many bubble conversations do you have with people, and everyone's trying to explain away why we're not in a bubble? And so when you start to see those valuations shift with higher yields, it's natural for people to start to get a little bit jumpy.
NASDAQ. Still positive, up 33, but also rolling over as well, up by about 0.25%. Important headline for you, Tom, coming out of the UK. Chancellor Sunak, the planned tax increase on alcohol and fuel will be cancelled.
There you go.
Will be cancelled.
That's important. That just makes the trip affordable.
Well, only 50% of that headline is useful for you. Don't know about the fuel part.
The fuel's for me when I sell my oil barrels in my
maybe
apartment.
for your driver.
Yeah, I was looking for the Bentley. The 2-year yield, John, with that 5 standard deviation move on Thursday, that was out to 0.17. We're nowhere near that angst.
No, we're not.
But I'm sorry, at a 0.13, you're getting up to October, November levels, 2 basis points away.
To hear from President Daly yesterday, talking up not yield curve control, but Operation Twist maybe. Again, let's try and touch on that a little bit later. And I've lost count. Coming up next, we'll get more jobs data out of the United States from the ADP report. It's claims tomorrow. It's payrolls on Friday. From New York City this morning, good morning. Heard on Bloomberg Radio, seen on Bloomberg TV. Mike Feroli at JP Morgan up shortly. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The Senate may formally begin debate on the pandemic relief bill as soon as this afternoon. The House has already passed the measure. Now a handful of moderate Democratic senators wants tighter targeting for jobless aid and stimulus checks. The Biden administration isn't counting on any support, so it needs all 50 Democrats on board. Today, 2 Senate committees will question federal officials about why it took so long to deploy the National Guard during the riot at the Capitol. Amongst those testifying, the commander of the District of Columbia Guard Unit, along with experts from the Pentagon, FBI, and Homeland Security. Last week, the former Capitol Police chief said the Guard didn't arrive for more than 4 hours after he asked for them. In the UK, Chancellor of the Exchequer Rishi Sunak has extended furlough payments to workers through September. That will protect millions of people whose jobs have been suspended during the coronavirus pandemic. The British government will keep the business rates holiday until June, and the reduced value-added tax rate will stay in place to September the 30th. And the Tokyo Olympics organizers will say a decision will be made by March 25th of whether to allow overseas spectators. They'll decide whether there will be limits on Japanese fans in April. Earlier, the Mainichi newspaper reported that foreign spectators would be banned from the games. And Las Vegas Sands is leaving Vegas. The world's largest casino operator is selling the Venetian and the Palazzo resorts for $6.25 billion. The buyers, Apollo Global Management and a real estate investment trust. Las Vegas Sands will refocus on its successful Asian resorts. The Vegas properties contributed less than 15% of the company's revenue in 2019. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch. It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City, this is Bloomberg Surveillance. The ADP report behind us. Claims tomorrow, payrolls on Friday. With your ADP report is Mike McKee.
John, it comes in much weaker than we were expecting. 117,000 jobs created in the U.S. economy in the private sector, according to ADP, during the month of February. The forecast was for 205,000. So the rebound not as strong as people expected from last month. The ADP last month number was revised up to 195 from 174, but their revisions generally follow the payrolls numbers, so you can't put a lot of stock in that. The breakdown of jobs created is kind of interesting because we lost jobs in the goods-producing sector, 14,000 jobs less, 3,000 in construction. Obviously, the weather was bad. We had some issues there. Manufacturing, though, 14,000 jobs lost during the month. Is that because companies are automating more, or is it because they have supply chain issues? It's hard to tell at this point, but that was not the expectation since manufacturing has been so strong. Service providing jobs up 131,000, but that's lower than we saw last month, 156,000 in the month of January. Most of the jobs, it appears, in services are in trade, transportation, and utilities, also professional and business services, healthcare, as always. The leisure and hospitality sector, the one that's been hit so hard, 26,000 jobs created, but last month in January, there were 35,000. So it's hard to get a clear read on what this means for the Friday jobs payroll report, except it does indicate some weakness, perhaps.
The charm of this, Mike, and you and I were around when this was launched, the ADP report, is a parsing of small, medium, and large businesses. What do you glean there, if anything, about the small business conundrum that Republicans and Democrats are debating?
Well, at this point, small businesses are gaining jobs, but not as many as they did the month before. 32,000 jobs last month compared with 51,000 in January. So it's kind of hard to tell. Now, most of the restaurants that we're talking about are fall under the small business category, the ones that have been really troubled. The big chains obviously have been able to get PPP loans, things like that. But the question is, how fast can they come back, or are they gone?
Let's jump forward to Friday. John Farrow and Lisa Lisa, are seeing this build up in the survey numbers. Citigroup out at 400,000. You saw 188 up to 2, whatever it's been. Do you just assume from now on a Wednesday, and now on a Wednesday through to Friday, we see that survey statistic go up?
It may go down based
Could
in
go down
part
off
on the ADP,
Interesting.
but we get another number coming out at 10 o'clock this morning, the ISM Services Index. We'll look at the employment subcategory there and see if the purchasing managers in the service industries see better times ahead.
It's really great, Lisa. John will have a full report on that ISM index.
I'm sure. Actually, it is a really important number. I will actually support his cause in raising the issue that a gauge on services is really important. Mike, I want to get your sense of the growth that we're seeing in small businesses versus medium-sized businesses versus large ones. Typically in a recovery, small businesses see the biggest job growth, the biggest, fastest growth, and that's what drives the recovery. Is this time different given some of the financial programs that were extended to the larger companies, perhaps not as much to the smaller ones?
This time is different in a way, Lisa, because of the nature of the recession that we are in, probably still in here. They haven't decided yet. Because so many small businesses were closed down immediately, what we're seeing is recovery in many of those businesses. Normally, when you have recession and it lasts a little while, then you see people start to borrow money and go out and start new businesses. I think that's probably not what we're seeing here. We're seeing some businesses that had been closed reopen. The companies that did get loans would still be on the books as employing their people. So it's probably a different kind of recovery. So we're going to see different kinds of numbers. Interesting, you look at the numbers in terms of the size of business this month versus last month, across the board lower this month, but the proportions are about the same.
So there's also a question, and Tom asked this or sort of flicked at it earlier when he said, are we going to care more about the retail sales number than the jobs report? At what point do these jobs figures really matter? In other words, what are you actually looking for to get a sense of the direction of travel here versus the headline numbers that are all over the place?
Well, I think you have to decide who you are and why you want to know. If you're in our business, if you're in the financial services business, you're going to be looking at participation rates to see if people are coming back into the labor force. That's what Jay Powell and others on the Fed have been talking about lately with that 10% unemployment rate. You add in the people who weren't looking for jobs. When they start coming back into the labor force, we could see the unemployment rate rise. But then that might be considered for a little bit better reason because people think that jobs are coming back. So we got to watch that above all else probably at this point.
Running through the price action right now. So a downside surprise on the ADP report at 117. The estimate was 205. Looking cross-asset at the moment. That bond market move sticks. Yields higher by 7 basis points on a 10-year to 146. NASDAQ futures rolling over. Still positive, but well off session highs. Up 25 and advancing 0.2%. The dollar index with a 91 handle. Just about. Mike McKee, the story of the bond market, the story of the week. The story's been a Federal Reserve reluctance to push back. Governor Brainerd did just a little bit. What do you expect in the days to come?
Well, that's going to be the interesting question for Jay Powell tomorrow. Does he want to push back? Are they concerned that this is going to keep going? I mean, we're trading in a range now. We've been at this level earlier this week. We fell back. Do we continue to keep going? If they think we're going to keep going, then they might bring in some options like Operation Twist, which they've been talking about in the markets. There's always yield curve control. Probably too early for that, and it'll depend on the speed of the move as well. But the Fed isn't going to like the fact they like the fact that the yield curve is steepening because it means people think the economy is getting better. But how far does it go to the point where you start to see some impact on economic activity? That's what they'll have to decide. And Powell, of course, has pretty much the last word before the Fed blackout period, March 17th, the next meeting. So going to be a lot of people paying attention to what he has to say tomorrow about this.
President Daley in the last 24 hours talking up Operation Twist maybe as the first tool to reach for if they want to address what's happening. Mike, good to see you. See Mike McKee through the morning into tomorrow with claims, and then payrolls Friday just around the corner as well. Tom Keene, what do they call this? Yields up at the long end. That's where your underperformance is. Yields pretty much unchanged at the front end.
The wonderful Ian Lingen over at BMO Capital Markets nails it right out. The disappointing report that Michael mentioned as well, John. But you get a bear steepening, and you get it with a vengeance, and that was a 2-year coming in immediately. And Lisa, John, has beautifully partitioned this week of yield dynamics in the short-term space versus yield dynamics in the long-term space. It's all a lot of sophisticated mumbo jumbo, but what it means is you get a steeper yield curve.
Well, and just in terms of economic reasoning behind this, basically the Fed is edified here, the idea that they need to continue to hold rates where they are, that they are not going to raise rates in the near future because the labor market still has a long way to go. That is the message. And so therefore, the fact that yields went up with people expecting that perhaps the Fed would raise rates earlier was given a dash of cold water with disappointing labor market figures.
John, do we need to get ready for 200 basis points, 210 spread?
210's right now, 134. 141, I think, was the high of last week. So not yet, but given how quickly things have moved, Tom, who knows? And to your point, if they're willing to sit on the front end and let the long end go, we can move higher.
That's what we're seeing right now. We'll see it, of course, all this information, John, Thursday and Friday as well.
Mike Ferroli, JP Morgan Securities Chief, U.S. economist. Really important conversation coming up shortly, right here on Bloomberg Surveillance for our audience worldwide. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg.
What's the biggest mistake you made when you were a fresh MBA grad and looking for a job?
Make sure you try to do something that you're interested in and that you think you'll be good at. I just was on a path to law school, and I actually never asked myself why I wanted to go to law school. And I randomly went to an investment banking analyst recruiting event, and I figured out I had an aptitude for it. I was interested in the work. If you're not interested in it, and it's not something you're good at, the money will not justify it. I also think that there's nothing wrong with experimenting. Doing something that you always thought you might want to do, or trying it for a couple of years, you can then go back down a traditional path if that's what you want to do. Try to remember what you want out of a job, where you want to live, what you want to get from it, from personal experiences, from development, from training, from fulfillment, from engagement in the community, and make sure you think about those things up front as you're recruiting and not try to evaluate it after you got there.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
Friday is Jobs Day on Bloomberg Television, the first full jobs report under the Biden administration. What will it mean for the new stimulus package? The February Jobs Report, Friday morning at 8:30 on Bloomberg Surveillance.
York City. This is Bloomberg Surveillance for our audience worldwide, live on TV and radio. Here's the price action. Downside surprise on the ADP report. Market looking through it for now. Up about 10 on the S&P 500, up 0.25% on the Russell. That's where your outperformance is, up 0.75%. That's the price action in equities. In the bond market, before that ADP print, this is what happened. Yields started to push higher, up by about 6-7 basis points to 146, approaching 147 on a 10-year. On a 30-year, steeper curve here, up 6 basis points to 225. That spread between 2s and 10s gets a little bit wider. Finish on this one. Touched on this a couple of hours ago. If you missed it, I think it's really important to recognize the difference between an inflation shock, what the economists are talking about, potentially happening, and a positive growth shock. What is developing right now before our eyes, and this is how it's captured in the commodity market. It's about real yields over the last couple of weeks. So what's happened year to date? Gold is lower, crude is higher. This is the story right now. Gold on the year, down by almost 10%, Tom. Crude, positive by 24. There's a big difference between the potential for an inflation shock and the reality of a positive growth shock running through this market.
In permeating all of this is a differential on the COVID, the vaccines, and what we're seeing, and of course the distinction between the Chancellor of the Exchequer in the United Kingdom versus President Biden in the last 24 hours is nothing short of stunning. Our next guest is important because a year and 2 weeks ago, Lael Brainerd was at the Booth School's seminar in New York. Obviously, it was, pandemic and all that. And Michael Ferroli, Kim Schoenholtz, Catherine Mann, and Steve Cicchetti wrote a definitive paper on the tools that we have forward on monetary policy. We come forward 54 weeks, and it's a whole new world after all. Michael Ferroli joins us this morning with J.P. Morgan. Michael, the paper that you wrote at the Booth School seminar of 54 weeks ago, is that paper true today? Are you and Bruce Kasman working off a new playbook?
No, I think the results from that paper were actually put into use a few weeks later, right? So that paper focused on the tools what we have that the Fed has when in a low interest rate environment, and we come to a recession, which is forward guidance and quantitative easing. They used both those tools very aggressively, and one of the tools that we recommended, and most economists I think recommend, we weren't alone in this, is outcome-based guidance, which is basically saying when the first hike will come is going to be based on certain economic conditions, which the Fed put into place last September.
What is so important here, and I believe John Farrell mentioned it an hour ago, where the United Kingdom envisions sub 2% GDP out a number of years as well. You own the study of potential GDP. Do you look at 6 or 7 or 8% GDP now? Is 1 quarter, 2 quarters fade out? Or 1 quarters, 2 quarters in a real abrupt drop down to where you see potential GDP?
So, first of all, I should say we see GDP growth this year around 6.5%, but we also see above-trend GDP growth persisting next year. So a lot of the stimulus that we're expecting should be somewhat delayed. So, for instance, a lot of the aid to state and local governments won't necessarily get spent quickly. So that should support growth on into next year. But, I think when we get to perhaps 23 or 24, it's reasonable to expect a return to sub 2% GDP growth, which is probably still the potential GDP growth rate of the economy.
Tom kicked off this hour talking about the Simon Kennedy article, about the savings rate, about the glut of cash sitting in savings accounts. In the U.S., he pegs it at $1.5 trillion. And then there's this nugget, that if everyone were to spend all of that money, GDP would run at about 9%. If none of it were spent, it would be 2.2%, a huge spread there. What gives you confidence that people are going to go out and spend it, and on what?
So, first of all, I would say a lot of that saving is accumulated stimulus that wasn't spent last year. But we should keep in mind that it's very likely that we're going to see further stimulus this year, right? So now we have potentially $1,400 checks coming perhaps within a couple of weeks. And we saw last year a lot of those $1,200 checks were spent pretty quickly. This year we would expect the same, perhaps even more so, because unlike last year, those checks may be coming at a time when the economy is reopening and you can actually spend on a lot of things that you couldn't spend on last year. So it's not simply the fact that we have a lot of accumulated saving, but there should be more income support forthcoming that I think should be the really big stimulus to growth this year.
Mike, give me a second. I just want to run through the price action at the moment. Up 7 basis points on 10s, up 6 on 30s, and the Nasdaq does roll over, Tom. Nasdaq futures now down by 36, call it 35, and off by about a third of 1%.
And just one observation, John. We go back to where we were on Friday. We've given up essentially Monday, Tuesday, Wednesday of dynamics.
This is the outlook gets better. And Mike, let's put some numbers on that better outlook. You've mentioned GDP growth. I read a note from you guys in the last couple of days, 685,000 monthly average for payrolls growth for the rest of this year. That just sounds absolutely fantastic, Mike. Are they the kind of numbers you're looking for now?
Those are. Two things I would say. One is that there's a link between GDP growth and job growth, or at least between the unemployment rate, which is called the Okun's rule that economists use. In addition, I would say that relative to that sort of rule of thumb, we might see more than one might expect in terms of job growth, because we're going to see a lot of sectors come back. We should see a lot of sectors come back that are things like restaurants and movie theaters that might be, services tend to be a little lower than average productivity, but that means you're going to have higher than average jobs per amount of GDP growth. So I think we're set for a very good year in terms of job growth. In addition, the participation rate we anticipate will mostly recover some of the losses it suffered over the past 12 months, in part because those who are concerned about face-to-face job seeking can actually get back in the labor market, as well as hopefully the normalization of school schedules should allow parents to get back into the labor market. So it should be good from both the perspective of the number of jobs created, as well as the amount of the population that's actually back in the workforce.
And perhaps markets have already priced this in, at least if you look at the equity valuations that we're looking at. And the question is, what happens 2023? What happens 2024? Even 2022, and whether there is sort of an ongoing virtuous cycle that gets created by some of the stimulus, by the job creation, and growth can go a little bit faster than people currently are expecting. What's your view on that, given the sort of consensus that we will see a slowing out of growth, a slowing out of inflation, and a return to the environment that we were in pre-COVID?
Right. So as Tom mentioned, we have been somewhat cautious on potential GDP growth, but there have been some developments that have been, I think, favorable when thinking about the longer-term outlook. One of those is that capital spending has really recovered quite robustly, particularly spending on tech, R&D, things that tend to be sort of high productivity categories of spending. So I think that's one favorable development. I think if we do get an infrastructure package later this year, which seems, likely, there's a lot of evidence that suggests that infrastructure is good for the economy's long-run growth rate. So there are still a lot of negatives out there in terms of slowing growth in the labor force that will, keep trend GDP growth definitely below 3% and probably below 2%. But there have been some favorable developments when we look at the productivity picture.
Mike, I want to finish up on the bond market. We've got a 30-year at 225, 10s at 146, yields bleeding higher again. Chairman Powell tomorrow. Do you expect Chairman Powell to stay on script?
I do. I think he's going to remain quite dovish. I don't know if he necessarily is going to have to fight the market per se, but I think he wants to, he'll have to reiterate that they're going to hike only when they are confident that inflation is going to be above 2%. And right now, it doesn't look like the inflation markets are pricing persistent above 2% PCE inflation. So I think Powell will have to address that perhaps misperception in the market that they're going to be quick to tighten even when there's no inflation pressure out there.
Dr. Ferroli, I want to steal a phrase from Jean-Claude Trichet, and that is the idea of diffuse. He was talking to me about productivity diffusing. What is the diffusement of stimulus? Do you and your combine over there under Bruce Kasman, do you have a confidence in knowing how stimulus will diffuse through the American system?
I don't think the economics profession really has a lot of confidence in understanding stimulus to the decimal point. We do think it will obviously boost spending, particularly the stimulus checks, and that should help the overall economy. And once we kind of get out of this patch we're in, where we still have a lot of excess labor resources, that should help a broad set of sectors in the economy. But I think we do have to be humble and kind of putting too much false precision on our understanding of how fiscal stimulus affects the economy.
200K, the number for Friday, Mike?
For Friday, we're looking for 200,000.
Okay.
Yeah.
Mike Ferrari, good to see you, sir. As
Good to
always,
see you.
JP Morgan chief US economist looking for 200,000 on Friday. The range anywhere from 430 positive to negative 35, Tom.
Do you do, Lisa and John, do you do pools on that? I actually won once and nailed the report. I've never done it since then.
I haven't done it for a long time. You want to do jobs guesses?
No, I don't do it. I don't do it.
Okay, what are you betting?
I'm
Let's
not
do
betting
this.
anything. I'm betting that I'll survive the week.
How about drinks on the person who loses? So we'll put out our views.
You want to put out a number?
You'll put out a
No,
number.
I don't. I don't want to. You guys can do it. I refuse to do it. But
Okay, so why are we talking about it?
Why did you bring this up?
I think it's so ridiculous. I mean, I get Ferroli saying 200,000, but do we all agree it's like a massive guesstimate?
We survey the guesstimates. 195 is your median guesstimate coming up on Friday. Direction of
To me,
travel
it's
is clear,
does the
though.
median move.
Mike Ferrari at JP Morgan is looking for much bigger numbers in the months to come. Tom.
That number, say that again, John, that number that you
685.
had.
They're looking for a 685 average. 685.
Average.
Average.
So that's 6-7 million people employed over 10 months.
Huge numbers.
And the point that he made here is that if it's a services-led recovery, that the productivity of each job is less. So you need more jobs to get created, more people to go work in those restaurants.
That's old school. Yeah, there's no question about that.
Old school recovery. And the reopening started. Let's be clear about that. Governor Abbott got things started, didn't he?
Yeah.
That's it. Bottom line. It's begun.
I don't know where we are on the clock. John, did you just see the Europe headline? Europe sales of new bonds exceed $1 gajillion in record time.
Yeah.
What do we make of that?
We're about to have a high yield record, I think, for this month.
Hold on one second. Tom, Al from New Jersey says that he'll let you charge the company Amex if you'll bet on payrolls.
Really? He said that?
Charge what?
Wow.
Drinks?
You know, we have to find someplace open, you know, hermetically
lunch.
sealed.
Or dinner?
I'm going to take a
Foreign
liberty.
drinks.
How about all of the above?
I believe jobs are going up
Who's that your impression of?
$242,000.
Seriously.
Who's that your
My Michael
impression of?
McKee impression.
That's your Mike McKee impression.
We're going up 242,000.
242.
242. Here we go.
Okay.
All right.
Thanks for that.
What I know is Red Sox pitching is horrific.
Wonderful.
That's all I know.
Well, this was a value add part of the show, the program.
It is?
Yeah, absolutely. Coming up on the Open in about 20 minutes' time. Credit Suisse's senior equity strategist Patrick Palfrey on Bloomberg TV. Tom will take you over to Bloomberg Radio to count you down to the opening bell. As we count you down to that, futures do roll over a little bit on the Nasdaq, briefly negative in the last 10 minutes or so. On the S&P 500, we're down 5 and off by 0.1%. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. ADP says American companies added a less than expected 117,000 jobs last month. The survey had called for 205,000. That underscores the labor market struggles to recover despite a decline in coronavirus infections the last few weeks. The government comes out with the February jobs report on a Friday. President Biden wants to speed up the timetable for most Americans to be vaccinated for the coronavirus. He says there will be enough doses for all American adults by the end of May, and he wants states to give teachers and childcare workers a priority. The president wants them to get at least one dose of the vaccine by the end of the month. And U.S. infrastructure has received a mediocre grade from the American Society of Civil Engineers. That should help President Biden when he asks Congress for a major infrastructure spending package. The engineers group says roads, bridges, sewers, and the energy grid remain underfunded. OPEC and its allies are set to cool off that rapid rally in crude oil prices. The OPEC Plus coalition is poised to agree on a production increase at Thursday's meeting. The usual differences are present. Saudi Arabia is cautious while Russia wants to open the taps. Still, all sides are ready to pump up more oil. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income. I'm Jonathan Ferro. This is Bloomberg Real Yield.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Continued momentum where businesses are rising to meet that challenge and meet that demand, and that's supportive of investment. This isn't just necessarily going to be the consumer propelling growth forward in the year ahead.
There we are on what's going on in the American economy. Sarah House of Wells Fargo there. They've got a really interesting number, 6.2, I believe, % plus, with maybe the tendency to move higher. We'll see. This is getting interesting, folks. Tomorrow claims at 8:30 and then on to the American Jobs Report. We'll have complete coverage for you at the 8 o'clock hour on radio and television on Friday. We'll go beneath the headline data. Right now is a joy. Lisa and I have really anticipated this through the morning. Srinath Narayan is with us with Bloomberg News, and he is absolutely definitive on any global Wall Street conversation on Goldman Sachs. He joins us now on the bodies moving out the door. Sri, Michelle Davis has a story on Heidi Lee, who no one knows who that is, of Goldman Sachs and M&A waltzing over to Fortress Diamond. It's not just about the big names, it's a lot of names. Are people exiting because it's the end of bonus season and they're going to new frontiers or new opportunities, or is there something else going on here?
Look, Tom, there is no denying the fact that this time of the year, this is the annual march you see across all the big shops on Wall Street. End of bonus season, you pick a new opportunity. But what is striking and puzzling and surprising about what we've seen at Goldman Sachs is it's not just the number of people who are leaving, but the kind of people who are leaving. In the last 3-4 days, we've seen 3 different division heads leave. Of course, every one of them will have a different reason, but 2 of them from one, your consumer bank head, one, the head of asset management, two parts of the business that are dear to David Solomon's strategy reshape of Goldman Sachs. When you see moves like that out of the bank, it certainly does bring the question as to why is it still happening.
Well, I know you're going to report on this as well as the known world, but I'm going to go back to, I believe it was a Harvard Business Review article of 3 or 4 years ago that said the world has changed and job joy is based on your direct report. Can you report to us, Sri, that people that have Solomon as a direct report are the ones leaving?
We've certainly seen some of that, Tom, no doubt about that. But we also have to remember that a key backdrop to all of this is David Solomon is keenly focused on reshaping Goldman, bringing corporate sensibility to it, and not focus so much on the Goldman halo of old. So there's no more alpha in being Goldman bigwig. And one wonders if that's driving some of the moves. And one thing I do think about is look at what they could look to do at some point with an acquisition or something like that. And every time people talk about that, especially with Goldman Sachs, the first thing they bring up is a culture clash. But when you work to homogenize the culture, snub off that Goldman halo, that isn't a big factor anymore, is it?
Well, Sri, but this raises a question of what the new Goldman, the reshaped Goldman, looks like. I mean, I'm thinking, for example, of consumer banking. That was one of the hallmarks of their new strategy, and yet the heads of that unit departed. They left to a fintech startup within Walmart. So what have we learned with respect to some of these departures, with respect to what Goldman Sachs, the new, will look like?
That's the thing here, right? That's why it startled everyone. You can understand moves from some other parts of the business that the bosses may not be that keen on, but to see those departures from a place of the bank like the consumer bank, Marcus, that is surprising. But it also tells you when Goldman thought that it could take on the banking behemoths by becoming a digital bank and encroaching on their turf, what they should have also realized, and they probably do, is that the moat is not that deep. And just as they realized there was an opportunity, there's a bigger opportunity for some of the corporate giants out there, like the Walmarts of the world, who have hundreds of millions of customers, and they could make a bigger move, possibly, than a Goldman Sachs. And that is the new reality we're dealing with.
So if you take a look at Goldman Sachs's share performance, it's actually outperformed JP Morgan, even though there are these questions about its direction going forward. What are the analysts who you speak to saying about the turnover that you keep reporting on?
That's the amazing thing here. You're talking about a time where the Goldman business has done really well. They had a phenomenal 2020, largely because of their Wall Street operation strength. Q1 has gotten off to a great start by all reports, and the stock price is at an all-time high. So you really should be seeing a sea of calm out there, but you're not. At this point, when the money is good, no one really cares. What happens when that goes away, then a lot of focus will go on the personalities and the culture inside the
Well, I want to go to the personalities and the heritage three that you mentioned, and we can go back to Sydney and John Weinberg, Gus Levy, and all of the trading platform of years ago. And the great phrase was that Goldman Sachs was always long-term greedy. They weren't going to play in the dust of the short-term gain. They were going to stay with a long-term perspective. From where you sit, and it's a dangerous question, I say it with respect, Sri, would you suggest that Goldman Sachs has had a cultural shift from the long-term greedy over to something that's new for Mr. Solomon?
I think there's absolutely no doubt about that, Tom. Imagine, forget Gus Levy and Sidney Weinberg. Go back 10, 15 years. Go back to the Hank Paulson and the Lloyd Blankfeins of the world. Imagine going up to them and saying, hey, I know you gave me a big promotion, but I'm leaving for a fintech startup that is backed by Walmart. How would that have played? That's inconceivable.
Yes.
But that is the new reality David Solomon is dealing with. And it's something that is keeping in mind the shareholders. He realizes that his shareholders want steady fee revenue. They don't want to deal with the vagaries of the massive upsides and trading that can come with downsides, and similar with banking. And that's what everyone has to deal with right now.
Sri Natarajan, thank you so much. That was wonderful. We look for your journalism on this. This story will not go away. Lisa, that was extraordinary there as he talks about the unimaginable of 10 or even 15 years ago at any given shop, and here, Goldman Sachs.
Yeah, the idea of also who the competitors are. I mean, if you think about it, it's big commerce, it's big retail, it's not another financial institution. And I do wonder, and this might seem tangential, but I do wonder how much the work from home and the sort of dissemination of some of the jobs really has also about where people choose to go.
I don't have any personal insight here other than to say I love the insight from Mr. Natarajan, the idea here that, you know, they're going to startups, they're going to the Silicon Valley-ish, they're not just going over to JP Morgan like they used to.
Also, where's the upside, right? I mean, that's the whole other idea of banks as a utility. And right now, the money's still there. So shareholders are excited about JP Morgan, about Goldman Sachs and JP Morgan, all the banks, which are flying and are still up pre-market, we should say, even as the broader indexes roll over.
We're not going to, well said, because we're not going to do the chart here, folks, but if you look at the performance of all these houses back to August of 2007, even with the new leg up that Goldman Sachs has enjoyed, it's really, particularly compared to JP Morgan, subpar. Lisa, what do you see in the markets?
Well, I was just saying that we did see that rollover, and it was pretty significant, and it did come pretty much in tandem with a spike higher in 10-year Treasury yield. So this basically, you know, there seems to be this mood in the market that yields higher isn't necessarily completely positive, but it's the churn beneath the surface, and we've been talking about that for weeks now. But you still see the banking stocks up. You still see some of the cyclicals doing all right and positive ahead of the open.
Well, we got a 1,600 handle on gold, 1711 down $22 right now on gold. Let's frame it up for the day. It's going to be an interesting day here off the enthusiasm of 3 hours ago to red and green on the screen now, and then into a report on the American labor economy, that claims statistic tomorrow at 8:30, and then on to the jobs report. Balance of power, Dr. Posen of the Peterson Institute. Stay with us on radio and television. This is Bloomberg.
What kind of leader are you?
I'm a leader that works on figuring out destinations that we should aim for and then chooses the direction.
A market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Yields up, stocks down. From New York City, for our audience worldwide, good morning, good morning. The countdown to the opening bout starts right now. 30 minutes away with equity futures down 8 on the S&P. We begin with the big issue. President Biden accelerating the vaccine timetable.
We're now on track to have enough vaccine supply for every adult in America by the end of May. There is light at the end of the tunnel.
As states across the country continue to loosen restrictions, Texas Governor Greg Abbott reopening Texas for business.
Effective next Wednesday, all businesses of any type are allowed to open 100%. That includes any type of entity in Texas. Also, I am ending the statewide mask mandate.
The country reopening, the pandemic improving, and another stimulus package could be on the way.
We're on track to send the American Rescue Plan to the President's desk before the expiration of the enhanced unemployment benefit, which occurs on March 14th.
Fueling optimism about the recovery, with economists on Wall Street racing to boost their GDP forecasts. HSBC, Deutsche Bank, PIMCO, B of A, and more, all upping their growth targets in the past month alone. Let's bring in the Bloomberg team, Kevin Cirilli and Kelly Lyons, for more. Good morning, Kaylee.
Good morning, John. Well, the vaccine timeline has moved up quite dramatically. The administration saying they will have enough doses to inoculate all American adults by the end of May, about 2 months earlier than originally anticipated. I would note that end of May target is strictly on the supply side. The timeline as to when everyone will actually have gotten shots in arms is less clear, though Biden called on states to prioritize teachers and childcare workers first. Now, the reason this escalation is possible, of course, is because there is now a third vaccine in circulation after J&J's approval over the last weekend. And now Johnson & Johnson has established a partnership with Merck for production of those doses. So that is allowing the U.S. to ramp up its vaccination effort. To this point, just shy of 79 million Americans have been vaccinated. The latest daily rate is about 1.94 million doses per day over the last week. And as that vaccination campaign ramps up, the COVID numbers are actually cooling down. The U.S. on Monday reporting new case count below 50,000 for the first time since October. The running weekly average now at the lowest in about 4 months. And given those trends, some states are now hastening their reopening efforts. We were just hearing from Greg Abbott, the governor of Texas, lifting the mask mandate and allowing all businesses to open at 100% capacity as of March 10th. That is a move that has drawn a lot of criticism from people across the aisle and health officials, given that Texas is actually lagging behind on the vaccination front. It's only inoculated 13.4% of the population, which ranks 46th out of the 50 U.S. states. And of course, the director of the CDC saying that with the variant spreading, letting up too early means we are at risk of losing the ground that has been gained. And Joe Biden, in his remarks yesterday, the president saying that it is too early to let our guard down, John.
Kelly Lyons, thank you. Let's bring in Kevin Cirilli for more. Kev, reopening down in Texas. I asked you about an hour ago. Where's the administration on this?
Well, we're anticipating new remarks from the administration later this morning, but to Kaylee's point, I can tell you that behind the scenes, Democrats are fully willing to have a debate over the mask, which they feel has been unfairly politicized. Yesterday, President Biden saying, quote, "There is a light at the end of the tunnel, but we cannot let our guard down now to ensure victory is inevitable. We can't assume that. We must remain vigilant, act fast and aggressively, and look out for one another." But beyond this, the politics really implementing the policy in Texas, and here's why. Governor Abbott wants to be seen as first out front of the reopening push. It's something that Governor DeSantis in Florida has also been politicking with, and as a result of that, over the short term of the next 3 months, look for conservative states to really jump on board on this. They feel that the constituents are on their side on this point.
Kevin, let's talk about stimulus too. $1.9 trillion worth of stimulus. An agreement down in D.C. to do more on both sides. Schumer says he's got the votes. Does Senator Schumer have the votes for what's on the table?
He does have the votes in terms of there not being a minimum wage included in this, and the minimum wage issue being pushed aside has really kind of cleared the path. And so I would anticipate, again, that this ultimately gets resolved within the next 2 weeks.
Kevin Cirilli down in D.C. Kev, thank you. Thanks to Kelly Lyons as well. Let's turn now to John Norman, shall we? JP Morgan head of cross-asset fundamental strategy. John, I want to start with this, the story in the commodity market. Crude's flying this year, gold is not. And if you can draw a distinction for us between a positive growth shock and an inflation shock, and which one we should be focused on right now?
You should be focused on the positive growth shock, because I think that's what's going to dominate and what's going to endure all throughout 2022. And I think the growth or the inflation surprises are going to be much more ephemeral. Meaning, I can imagine inflation being a bit higher than expected in the spring as the economy reopens and some of these supply bottlenecks are realized. But I really doubt that's going to stick through the whole of 2021, because there's excess capacity. There's excess capacity in the labor market. There's excess capacity in commodity markets like oil. So the story every quarter for the next several quarters is a lot of growth. The story maybe just for the next quarter is some inflation surprises to the upside.
John, so if that's the analysis, let's talk about the portfolio construction. What drives the difference? What is the difference between a portfolio set up for an inflation shock and one set up for a positive growth shock?
So a portfolio that's set up for an inflation shock is also a portfolio that needs to be set up for de-risking, because if inflation is a lot higher than what the Fed is comfortable with, then they're going to start tightening. And anytime the Fed starts tightening, there's a lot of late cycle phobia that starts to get built in around restrictive monetary policy and the end of the expansion. So it's hugely important that you have a high conviction view that we won't have a durable inflation shock. If that's what you believe in, then yes, you want to be exposed to some of these assets that do very well when inflation's rising, like commodities, but you don't want to be near risk. But because I think the base case is extremely strong growth, and I think the tail risk is inflation, and that tail risk only gets materialized in a few years. I want most of the exposure to be in the cyclicals. That's in value stocks, it's in cyclical sectors, it's in equities, it's in high yield credit. It's a little more tactical and nuanced around the EM exposure, but it's definitely a pro-risk portfolio.
Well, let's touch on that more nuanced point at the very end there, John. How you balance your exposure between EM and commodities with the view you've just painted.
So think of EM as a cyclical asset, but one with a lot of cross currents from higher U.S. interest rates and how that often sponsors dollar strength. And think of commodities as being mainly a play on a much stronger business cycle without a lot of interference from rates markets. So there'll be times when both of these markets are moving in the same direction, higher commodities, higher EM. But because right now I think the focus is much more about short-term inflation surprises, an upward move in yields, short-term dollar strength, I think EM is going to be an underperformer. But once we get through that indigestion problem in the bond market over the next couple of months, I think you're going to see EM recouple with commodities higher. So EM is going to go higher versus the dollar. The spreads are going to compress in the local bond markets. EM equity is going to outperform as part of the broader value rotation. And I think that'll move alongside the upward move in commodities ex gold. Gold to me is just another version of bond duration.
John, join the dots from then that story to the Fed, because this is important. The Federal Reserve right now, I caught up with Mike Feroli in the last hour, your colleague, the chief economist, US economist over at JP Morgan, looking to average 685,000 average monthly payrolls growth, which is just unreal through the rest of this year, John. When you look at that and the pricing at the end of easy money, so to speak, you still think it's too premature?
I think the bond market is getting a little overexcited at the front end. It's pricing in a liftoff of the Fed and a pace of tightening by the Fed, which I don't think is going to get realized. The problem is the long end is still somewhat rich. If you look at 10-year rates, they're below the level that's consistent with an economy that's going to be printing 2% inflation on average. So, there's a bit of schizophrenia in the bond market where yes, Fed expectations are too elevated, but the bond market is still rich in the intermediate part. That's why I think you can still have these recurring kind of vol shocks from bonds as we get these strong numbers that Mike is looking for, and as investors start to debate exactly when is the Fed going to move both on the tapering side and on the tightening side.
We'll talk about whether Chairman Powell steps back in tomorrow. John, stick with us. Looking at the bond market right now, up 7 basis points on 10s to 146, on 30s up 7 to about 126, 226 rather, at the long end. That's the yield curve story. With your movers at the market desk, here's Abby.
Well, John, let's connect that yield curve story to stocks, because earlier we had the futures solidly higher. Now we have the futures lower, and the big drag, of course, is coming from yesterday's lagging sector technology. If we take a look at the big tech and internet movers, we're going to see declines. Earlier, these stocks had been higher. Apple's down, Microsoft lower, Alphabet, Amazon. Not huge losses, but we have about $6 trillion worth of market cap there. So that's why, again, the futures are off the lows, or the highs, I should say, with this reversal. Valuation comes into question as yields rise. Rising yields, though, what sector's doing well? Of course, the banks. If we take a look at the big banks, lots of green on this screen. Probably the story of the day. Tech down, banks higher, reflation on. But again, as the 10-year yield approaches 1.5%, John, is it that reflation story, or will folks start to worry about inflation?
Weighing in on the tech sector, Abigail Doolittle. A little bit later, much more still to come. This is the story right now. The numbers I went through a little bit earlier on TV and radio, 27, 11, 10, 27, the weighting of information technology on the S&P 500. 11 is the weighting of the financials, and 10 is the weighting of Amazon and Apple alone. Down the last 30 days, down and down hard. So if the financials are ripping and your big tech players, which make up a big part of this S&P 500, are trending lower, it is difficult to get through 3,900 sustainably. We'll talk about that a little bit more a little bit later. Up next, surging bond yields weighing on the Fed. That conversation coming up with John Norman and George Bory of Wells Fargo. From New York City this morning, good morning. This is Bloomberg.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's certainly to a large extent linked to the movements in the United States that in a sense affect our rates over here. In that sense, it is not linked to inflation expectations or a better economic outlook. On the other hand, we also have to see to what extent do these movements affect our ultimate goal, which is price stability.
Bundestag President Jens Weidmann there taking a closer look at the dramatic moves in the bond market, while in the US, the first Fed official finally joins in.
Some of those moves last week and the speed of the moves caught my eye. I would be concerned if I saw disorderly conditions or persistent tightening in financial conditions that could slow progress.
Joining us now is Bloomberg International Economics and Policy Correspondent Mike McKee. Good morning, Mike.
Good morning, John. Well, you consider the source, of course, with Jens Weidmann. He's the president of the Bundesbank. They're going to be the inflation watchers in Europe. But take a look at what's happening with inflation expectations, and he's not wrong. The United States growing much faster, and the potential for growth much faster, is at this point showing a much greater inflation expectation than the rest of the Europeans, particularly in Germany. You look at swap spreads. So does the Fed act? Does the ECB act? It's a kind of a question at this point, as one of your countrymen once said, John, jaw or war. And right now it looks like jaw, at least from what Brainerd and Weidmann are saying. With QE, the Fed has been buying at the shorter end of the curve. Of course, that's where their policy remit is. And so the question in people's minds is, do they keep doing that, or do they start to buy at the longer end? An Operation Twist. The last time they did that, in 2011, you can see what happened. The red area there is when they were running Twist, and it brought down the 10-year yield. So there is some thought that if we see this continual move in the bond market, that's what we're going to get. The advantages, markets understand it. In theory, they wouldn't sell off if the Fed signaled it was going to do this. It doesn't affect the balance sheet, and it doesn't affect the reserves in the system. You're just moving them to a different place. Now, the question is, would the Fed do this without sending a signal? No, they wouldn't. And so that's why everybody's going to be watching Jay Powell tomorrow to see if he sends any kind of signal, because he gets the last word basically before the blackout starts this weekend ahead of the March 17th Fed meeting.
Mike McKee, much more from Mike. A little bit later, we get the PMI from you, Mike, as well as the ISM at the top of the hour. Claims tomorrow, and then payrolls coming up on Friday. Chairman Powell tomorrow, too. Ahead of all of that, futures a little bit low. We're down 0.2% on the S&P 500, 15 minutes out from the opening bell. A big year of growth coming up in the mind of so many economists. It's the thank you next of this that is interesting. What happens after that in 22? In 23, and what happens to the bond market too? Guggenheim's Scott Minerd warning that Treasury yields could still turn negative, writing in a note the following: the foregone conclusion today is that long-term rates are on an uninterrupted trajectory higher. History tells us something different. Joining us now is George Bory of Wells Fargo, and still with us, I'm pleased to say, is JP Morgan's John Normand. The thank you next of all of this. Let's talk about this, George. 21 is going to be big. What's 22 bring, and what does it mean for this bond market?
John, you make a great point, and as your colleague just mentioned, obviously bond yields are on the move. They have been for the last couple of weeks, and now there's a lot of discussion about what's going to happen next. What's going to happen next this week, next month, and as you point out, into 2022. In the very near term, as you just heard, the market is looking for validation. It's looking for confirmation that the move up is warranted. The move up in yields is warranted, and it's going to be a combination of both policymakers and data. And there's a battle right now between the Fed and the market. The market's trying to push the limits of the Fed, and it's our view that the Fed is other than kind of trying to jawbone the market, unlikely to signal that they're actually going to do anything, at least not yet. Yields are still very low. And yes, real yields have risen, and that is something to keep a close eye on. But so have expectations for economic growth, and economic growth overall seems to be improving. To the extent that continues and carries on into this year and into next year, then it's almost a foregone conclusion that bond yields go higher. If you look over long periods of time, nominal yields and nominal growth, they tend to align and